Yahoo Finance, I'm Shauna Smith alongside Brad Smith, and we got some breaking news on inflation data. The CPI print just released for the month of December. And taking a look at these numbers, coming in a bit hotter than expected, at least a month-over-month basis for CPI. The increase there, 0.3% move to the upside. That was stronger than what the street was looking for. 0.2% move to the upside. When you take a look at the core number on a month-over-month basis, coming in line with expectations, 0.3% rise. Now those headline numbers year-over-year comparison. CPI headline number coming in at 3.4%, again hotter than what the street was looking for. The core number also coming in at 0.1% higher than what the street had been anticipating, which is coming in at 3.9%. Now that is down when you compare it to the prior reading that we got on core inflation of 4%. But again, core inflation coming in just a bit hotter than what the street was anticipating at 3.9%. And we're seeing some reaction play out in the futures markets right now, Brad.
Let's take a look at some of the indexes within the index here. Index for shelter, that continued to rise in December, contributed over half of the monthly all items increase there. Energy index, you also saw that rise by about 0.4% in the month. Increases in the electricity index and the gasoline index more than offset a decrease in the natural gas index there. So that's some of the kind of larger items here. But the index for food at home, that increased 0.1%, and then index for food away from home rose 0.3%. So all those people who are either cooking at home or perhaps ordering a little Seamless, Grubhub, DoorDash, Caviar, whatever your vice may be, you're contributing to one of those figures one way or another. And then lastly here, just want to quickly hit the household furnishings and operations index, personal care, among those that actually saw decreases over the month. So we'll dive further into some of these with our reporters that are standing by. But that kind of like the headline takeaway on the indexes within this broader CPI reading.
Yeah, and of course, the big takeaway from this is exactly what this could mean for the Fed. A lot of anticipation going into this print. If we were to get a reading that's slightly hotter than expected, would that then be enough for the Fed to potentially push off any plans of a rate cut, at least in the first half of the year? Of course, second half of the year, whether or not that would delay any planned cuts and really change the calculus at the Fed in terms of what they anticipate we are going to see in their fight to tame inflation. Now, once again, inflation proving to be stickier than many forecasters had anticipated for this month. A similar story to what we have seen play out over the last several months. So exactly how this impacts Fed policy will be the focal point here this morning.
That's right. We're keeping a close eye on the futures here this morning, as you've been seeing in the corner of your screen. For more on that, let's get to some heat map action and the Wi-Fi Interactive. Jared Blickery, he's standing by. Hey, Jared.
Hey there. Well, we flipped from green to red here. You can see the Russell 2000 futures. Those are off the most, down about 0.5%. Nasdaq down about 12 basis points. Not a big movement, especially in comparison to the last 5 days of trading. You can see just a little bit of a blip right there when you compare it that way. Let's take a look at Treasury futures. These move inversely to yield. And here we have the 10-year T-note futures, and we can see that we took a pretty big drop. Again, we want to get some context. So let's put that in context of the 5-day move, simply to the bottom of a trading range over the last few days there. That means yields are heading up in the 10-year tenor, and a very similar story for the 2-year, although it looks like we have bounced off of those lows. And let's take a look at copper futures. Sometimes you get some movement in there as well, just a little bit of downside action. And gold. Gold has really been on fire recently, hitting all-time highs, and it looks like we got a little spike there. And let's put that in the context of a longer term. Here's a 2-year chart, and you can see here are the record highs. So we're pretty close to those right here. And let's get a check of the sector action. We have some sectors in the green. That would be energy, consumer preferences there reflected in XLC, communication services. That's up 0.4%. Discretionary real estate. All of those are outperforming, but financials taking a hit to the downside. Also tech. We want to take a look at the Nasdaq 100 and also take a look at financials in a second. We have NVIDIA threatening another record high on the open. It had one yesterday. It's been on a tear over the last 4 or 5 days. That's up 1%. We also have Amazon up about 1%. And then just taking a look at the financials, because we got those big bank earnings coming to you this Friday. JP Morgan down 0.5%. We should note that these stocks are very interest rate sensitive and also sensitive, therefore, to inflation. So JP Morgan down about 0.5%, HSBC down almost 2%, and Bank of America down about 0.5%. Guys, I do want to close on crypto. I'm going to be doing a deeper dive. We got those spot Bitcoin ETFs that are set to take place trading on the open, and we are off of the lows here from about 45,000. Let's just take a look at the 5-day price action here. We are pretty close to those highs, so impressive that we are seeing Bitcoin maintain those gains, but not stocks. Not stock futures.
All right, Jared, thanks so much. Let's get into this report, the reaction that we're seeing play out in the equities markets, also the bond markets. For that, we want to bring in Stephen Juneau. He's Bank of America Securities U.S. economist. It's great to have you here. So just the first reaction to this hotter than expected inflation print that we got out here this morning. What do you think this signals then for the Fed? Is it enough to potentially delay cuts?
I don't think it's enough to delay cuts. So I think, it was about in line with kind of the ballpark of our estimates. It's about a few basis points off in terms of our core print. So really, I would say for the Fed, we're looking for a March cut to kind of kick off the cutting cycle. This kind of keeps the door open. It definitely doesn't slam the door shut. If we had seen something like a 0.4% on core, one of the big reasons for the firmer print is that, at least relative to our expectations, is that used car prices actually increased. We were looking for a decrease there, but we know that declines in used car prices are in the pipeline. So if we didn't get them this month, we're probably going to get them in January or February. So you're going to see that kind of come off. The big concern for the Fed, I think, is that there's still this dichotomy in the data. Core goods prices are deflating. You still saw that again this month. That's supply side driven. It's not necessarily driven by the Fed. But core services remain firm and shelter really remains firm. And we really need to see progress on services to really feel confident that we're going to get back down to 2% on a persistent basis. But that doesn't mean that the Fed can't start to gradually kind of ease off their restrictive stance.
Steve, I want to linger on that firmness that you were mentioning and that we brought up at the top of the reading here on shelter particularly. Where do you believe or when perhaps do you believe that some of the Fed's policy will actually trickle through to the shelter part of this?
Yeah, so shelter is an interesting one, and we've been waiting for it to happen. I think what we're learning is that kind of, if you're on the rental market today, if you're, looking to rent a new apartment today, you're looking at more attractive rental inflation. You're finding discounts out there. There's a lot of supply on the market. But the issue is when you're talking about the CPI methodology, when you think about the contract rents, it's the average rents that everyone's facing. Well, what we're learning is that lag between asking rents, what a new renter is facing, and CPI rents, well, it's a little bit longer than we expected it to be. So when will we see it? It's $1 million question. We're still trying to figure it out. We think it's going to happen gradually. I think what you're seeing fundamentally is that the Northeast is still an area of strength in terms of rent inflation. The rest of the country has ample supply. It's adding a lot of supply, and you're seeing kind of more discounting there. So it's really kind of this regional dynamics, and that can lead to maybe firmer prints on shelter. So it could take some time.
Actually, that's what I was about to follow on. Is this as simple as more capacity being brought online to then in some of the more expensive rent or owner's equity rent kind of equivalents, if you will, as more capacity comes online, the common thinking is that, supply and demand characteristics would say pricing would come down. But is as simple as that at the end of the day?
Yeah, absolutely. If it were a simple thing to add rental supply, then I think it would be as simple as that. I think the issue is where you are adding rental supply, which is kind of in the South, in the West, in the Sun Belt. You are seeing rent prices come down. You see it in the CPI data still. Where you're not seeing rental supply really being added, the Northeast, right? It's more landlocked, it's more developed, there's greater density. Those areas, well, you're seeing still firmness there. You're also probably seeing some return of population to those areas from prior to the pandemic, right? You had kind of that outward movement during the pandemic, and now those people are starting to come back. So that probably boosts the demand picture there.
Stephen, what are some of the seasonality factors that we need to keep in mind, especially when you take into account or take a look at where we did see some of the pricing increases last month, airfares being one of them. It was during the peak holiday travel season. So put that in perspective for us and how you're taking that into account when you're making your forecasts.
Yeah, that's a great question. So, what we do is we always take the seasonal factors into account, and airfares has a large seasonal factor in December. So that probably helps explain that. Really, when you look at, say, non-seasonally adjusted data, airfares were actually down on the month. So when you just look at domestic average ticket prices, so it's really kind of the seasonal factor that's probably contributing to that rise. And maybe what that means kind of as we go forward, airfares is a small component of the basket, but what that might mean as we go forward is maybe January and February look a bit softer than December.
One of the other areas that we have to continue to keep a close eye on, and it's come up as an investment thesis that we've discussed with some people in the healthcare sector, specifically medical care indexes rose by about 0.6% in December, about the same as it did in November, roughly. Hospital services increasing. We saw prescription drugs index actually fell 0.4%. Perhaps that could be mechanisms of more competition that's entering into the market here. But that is a service that people are going to need to continue to buy into one way or another. How sticky is that element within future readings from your anticipation?
I definitely think there's some stickiness there. I mean, it's always going to be something in demand. When you think about kind of the structural demand forces for medical care, well, we have an aging population. So the demand for kind of medical care services, that's just going to keep going up. And we are seeing kind of rapid hiring in that sector, relatively strong wage inflation as well. So there is room for firmness there, definitely. Where you have to be careful, I think, in the CPI data is there's just some methodological quirks around the health insurance calculation. So that's part of the story there. Why you saw kind of weaker readings last year was really due to the health insurance component and how BLS really goes about calculating it. And this year, the health insurance, how they calculate it is just a little bit more positive. So that kind of contributes to what we've seen over the past 4 months or so. But getting to your point on, say, hospital services, physician services, I think that's kind of structurally something that we'll continue to deal with. Healthcare costs are expensive.
And Stephen, squaring this with the jobless claims numbers that we also just got out here a few moments ago, coming in at 202,000, lower than what the street had been expecting. So when you take that into account, the fact that the labor market has been holding up now and remains tight pretty much, and then you compare that to the stickiness that we're seeing in inflation, how do you think the Fed is looking at that most recent data? And then looking ahead, what do you think are the key data points that investors need to keep a very close eye on?
So I think inflation is still probably the biggest focus when you're talking about kind of the timing of the first cut. We need to see, we've obviously seen with core PCE inflation over the last 6 months on an annualized basis, we're running at 1.9%, right? That's slightly below the Fed's target. So I think where we're getting is some progress there. So we need to just see that continuation. If they see that over the next couple of months, March is certainly open for a cut, and that's what we think will happen, right? So we think they'll kick off the cutting cycle there. Now, when it comes to the pace of the cutting cycle, that is where I think the labor market plays in for the Fed. So obviously with the claims data, we're still seeing, really good claims numbers. We're not seeing layoffs. That's consistent with the JOLTS data. When you looked at the NFP data from December, you're still seeing strong hiring, rapid hiring there. It's narrowly driven, of course, but it is still positive. The unemployment rate's still below. So that is why the Fed, we think, will be gradual in this cutting cycle, right? Because you still have this tight labor market. You have to worry about kind of those fundamental drivers of wage inflation supporting kind of inflation getting stuck maybe a little bit above 2%. Wage inflation isn't too high, right? It's running at 4%. So maybe that's consistent with 3% inflation. But, I think the labor market really dictates maybe the pace of the cutting cycle. Do we see sequential cuts? Do we see a 50 basis point cut? That's where the labor market, I think, really comes into play. If we see significant kind of deterioration in labor demand, which we aren't seeing, obviously, the claims data is a great leading indicator for that, then that's where the Fed can get a little bit more worried about the economic outcome and really start to cut more quickly.
Steve, always a pleasure to get some of your insights and put some more color around the data that have come forward. Stephen Juneau, who is the Bank of America Global Research U.S. economist. Thanks so much.
Thanks for having me on.
Absolutely. We'll have much more market coverage for you at 9 a.m. Eastern right here on Yahoo Finance. Boeing CEO Dave Calhoun is finally speaking at a 737 MAX factory in Washington. He said the company will approach the situation by acknowledging their mistake after a door plug on an Alaska Airlines flight blew out at 16,000 feet in the air. As the CEO tries to salvage the situation, our next guest says that the incident is a manufacturing issue, which should be considered when looking at who bears responsibility. We've got Jason Gursky, who is the City Managing Director and Aerospace and Defense Lead Analyst, to discuss more. Jason, thanks so much for taking the time to help us dive further into this as we've been tracking this story and any new developments throughout the week. Most notably here in what you're mentioning in the manufacturing side, what needs to change from a Boeing manufacturing perspective that now again has the MAX front and center?
Yeah, look, I think the first thing we need to do is, make that delineation between a manufacturing issue versus a design issue. And this really does look like it's a manufacturing issue and not a design issue with the aircraft. If it was indeed design related, we'd probably have a bigger problem on our hands here because they'd have to go back and redesign the aircraft and get it back through a certification process. And we'd probably be facing much longer delays. On the manufacturing side of things, it looks like there's the potential here of some poor quality. We've seen some quality escapes at Boeing and its suppliers here over the last 12 months. Last spring it was the tail section of the 737 fuselage, and then over the summer it was the aft bulkhead section that had some quality escapes. And this looks like yet another one. So what do we need to do here? We probably need to hire some more people that are doing these kinds of inspections. The industry writ large has struggled with getting, experienced employees into these factories post-pandemic. So I think that's probably a contributing factor here. It's just it's been hard to find really qualified people. So doubling down the efforts on getting people up the learning curve in the industry, understanding what they need to be doing, and then doubling down on hiring inspectors and just focusing a little bit more on quality, both on the Boeing floor as well on the floor of all of their suppliers.
Jason, I'm curious to get your perspective on how Dave Calhoun, in your view, has handled this latest issue, just in terms of what we heard that he told employees at the all-hands meeting, vowing complete transparency here going forward, admitting the errors that were made. Are you confident he's going to be able to rebuild what seems to be a damaging image that we're seeing as a result of this for Boeing?
Yeah, look, I think the first part of any recovery, right, is admitting you've got a problem, and that's a healthy thing. I think he's being very transparent with the regulators. He's being transparent with his customers. He's being transparent with his employees as well about what the challenge is here. I would think that this would be a very humbling event, not just for the management team of Boeing, but for the guys and gals working on the factory floor, right? They take a lot of pride in the work that they do, and delivering a product that works safely and transports millions of people every day. So I've got to imagine that this is a very humbling experience for everybody involved here. And I think, the way that they're managing this, I don't know what more they could do at this point, right? Admit you got a problem, admit that you're going to work with your regulators and your customers to get it fixed. And trying to motivate and reemphasize to the employee base that, look, Boeing is supposed to stand for quality and safety, and we got to make sure that we're doing that every day.
Is this incident perhaps insulated enough to the point where it is not an overhang on future revenue or even profit for Boeing?
Yeah, I've never say never, right? I mean, we have seen quality escapes over the last 12 months, as I suggested a minute ago. Now, fortunately, none of those were safety of flight issues from a quality perspective. But look, the Dash 9 doesn't have a lot. It's a bit of a unique product, right? It's one that is configured to be able to have much denser configurations, and therefore it has these extra doors associated with it. Most airlines are not flying it in that really dense configuration, which means they're plugging the doors. And this has been going on since the late 1990s, right? The 737-900ER, similar, had those doors. They were plugged. We haven't seen any issues like that. The current variant of the aircraft, the MAX, has been flying since 2015. Again, no issues. So it seems like the design's good. And, there aren't all that many aircraft that Boeing is shipping out that have these plug doors, right? This is a bit of a unique product. So hopefully it is, constrained or specific to this one product. We develop a better process on checking things out before they think it all goes out the factory floor, and we get these planes back in the air sooner rather than later, and this ends up just being a small blip in the long history of Boeing.
Jason, when it comes to, and you think it's a limited impact in terms of financially, as at least the information that we've gotten so far, but when it comes to the current orders, future orders of the 9 model, do you see Boeing being able to convert those orders to some of their other models, and what does that roadmap look like?
Yeah, I mean, there are only about 120 orders on the books today. So look, if they decided they're just going to walk away from the Dash 9 product, which I don't expect them to do, but if they were, they would work really hard to convert those into orders for other types of aircraft, either the Dash 8 or the Dash 10. I don't think you convert a Dash 9 order all the way down to a Dash 7, which is the smallest variant of it. You probably go on either side of it, the Dash 8 or the Dash 10. Now, the Dash 8 is the one that's currently certified and they're delivering today. The Dash 10 still has yet to be certified. So I guess the proclivity of airlines, if they need lift sooner rather than later, would be go to take the Dash 8 because it's certified and there's no uncertainty around when it might get certified.
What is, if any, responsibility does the FAA have within this process as well? Because perhaps that's where it drew our attention back to the relationship that Boeing has with the FAA, where the FAA has oversight, at least in making sure that beyond the design and then even into the manufacturing, that each of these aircraft are getting green lit to go out the door.
Yeah, look, I mean, technically the FAA does sign off on these aircraft when they get delivered, right? And, as I suggested earlier, this configuration with plug doors has been around for a really long time, and we've never had an issue on it, right? So, the way that this kind of works is that Boeing, does things and, builds up a very nice long track record of doing things well, to the point where the FAA says, okay, you know what, I don't need to come in and inspect that. You guys have been doing that now for decades. Just continue what you're doing. And, it's costly for, us taxpayers to have, the FAA going out and doing things like that. So, look, budget constraints and budget cuts are real, and they have real impacts, in Washington. So I don't want to, this isn't the FAA's fault, but they have constrained resources themselves. So there's this, kind of dichotomy going on where you'd love the FAA to be signing off on every and overlooking every single process. That's, from a budget perspective, not possible. And you've also got long history of, safe operations of an aircraft that, the FAA would look at and say, I got a triage where I'm going to go do my work. And this one was not on anybody's list, right? Because we've got such a long, safe operational history to date.
Jason, great to get your insight here. Thanks so much for taking the time again, taking a look at Boeing shares bouncing off the lows, up just about 1% in today's session. Thanks so much, Jason. It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. Tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We have a big show for you today. We're covering the top stories moving and shaping markets this morning. A fresh set of inflation data and a milestone moment for crypto. Several exchange-traded funds tied to the spot price of Bitcoin will start trading today in the U.S. One of those money managers is Grayscale. We're going to hear from the CEO, Michael Sonnenschein. That's at 9:30 a.m. Eastern Time to hear more about what this means for the company moving forward, along with Senator from Wyoming, Cynthia Lummis, and ARK Invest CEO Kathy Wood's take on the historic decision. But first, let's lay out your roadmap for the day and get right to it with the three things that you need to know as we head into a new trading day. Yahoo Finance's market reporter Josh Schaefer, Jared Blickery, and Madison Mills are around the newsroom with more.
Hey Brad, inflation data coming in hotter than expected this morning. Consumer prices rising 0.3% in December, pushing that annual rate to 3.4% despite a rapid cooling seen through most of 2023. It seems victory might not be able to be declared against inflation just yet.
And the Securities and Exchange Commission have given more money managers the approval to launch 11 spot Bitcoin ETFs. Several are trading today, and crypto exchange Coinbase is playing a huge role, acting as a custodian for the majority of the applicants approved today. Coinbase Chief Financial Officer Alicia Haas spoke to Yahoo Finance about the decision yesterday.
Today was a landmark day for crypto. 10 years ago, the first application went in, and today we got 11 ETFs approved from the SEC, as you noted. And many of those did highlight Coinbase's extensive role in it.
We're going to break down what this milestone moment means for Bitcoin's price.
And Citigroup in the middle of a complicated restructuring. The investment bank saying in a regulatory document it'll take more than $3 billion in one-time reserves and expenses as part of those fourth quarter results. Now, Citi, one of the heavy hitters kicking off the fourth quarter earnings season alongside peers JP Morgan, Bank of America, Wells Fargo, and BlackRock.
Let's get to our top story of the day. The December CPI report showed prices were higher than expected. We saw prices rise 3.4% year over year compared to 3.2%. That was the expectation, and 3.1% was last month's reading. The energy index driving a lot of those gains. Also, that volatile core inflation that excludes food and energy came in at 3.9% year over year. We've got you covered with the three biggest takeaways from the report: housing, food, and car prices. Josh Schaefer, Supermanian, and Brooke DePalma are standing by. Hey, Josh, shelter still the lead gainer in that CPI print.
Yeah, Brad, so shelter accounting for more than half of the price increases that we saw in December. That's according to the Bureau of Labor Statistics. So I want to give you those numbers here and run through them for what we saw in December shelter inflation. When you take a look at that shelter inflation, you're looking at rent month over month increasing 0.4%, year over year increasing 6.5%. And then when you look at homeowners rent equivalent, that went up 0.5% month over month and 6.3% year over year. Really not much of a decline from the price increases that we saw in November. We know overall housing has been a key part of this story and is one of the main things that's still holding up inflation and providing significant upside risk to inflation. Now, of course, economists would point to some of this data in the BLS is a little bit lagging, and there's other rent inflation data that you could look to that says the grass might be greener on the other side in the long term. But for today, this is the report that we have, and the shelter index is contributing a significant amount to that hotter than expected number, which for now markets don't seem to love. Of course, we're always wondering what that could mean for more Fed rate hikes. Pras Subramanian, though, is standing by in the newsroom with more on auto prices. Pras, what do you got for us?
Hey, Josh. Yeah, continued moderation in auto prices is the theme here. Let's look at new cars. In December, prices rose 0.3%, but only rose 1% year over year. A big drop compared to last year's nearly 6% jump as disinflation hits the sector. Turning over to the used market, prices climbed 0.5% for the month. A trend we've been seeing as the market reaches some stability after falling considerably. And we see that in the year-over-year figure with used prices falling 1.3% after they fell nearly 9% in 2022. We're seeing the same type of trend in the used wholesale market or auction market with the Manheim Index dropping 7% in 2023 as well. Brooke De Palma is a touchscreen. Brooke, are grocery prices coming down at all?
Not yet, Price. Good morning. Food inflation continues to moderate, but the cost of food in the month of December was still up 2.7% compared to last year. Now, groceries in particular jumped 1.3% year over year and up 1.01% in the month of December. Now, the cost of dine out jumped even higher, up 5.2% compared to last year and up 0.3% month over month. Now, this will be something to watch in 2024 as restaurants look to bring in customers and increase foot traffic, even with these higher prices, which are being used to offset higher labor and food costs. Now, taking a closer look at some key items that saw the biggest month-over-month jump includes uncooked beef steaks, ham, fish, and seafood. And remember that top egg producer here in the U.S., Cal-Maine Foods? Well, they reported a case of the bird flu and shut down their Kansas production facility. And we're already seeing the impact there. Egg prices jumped 8.9% month over month after we saw some moderation at the end of last year. Sean and Brad, back to you.
All right, Brooke, thanks so much. Let's dig into this top story of the day and take a look at the market's reaction, what it means for your portfolios. Right now, we have futures moving lower on the heels of this hotter than expected inflation print. Housing driving more than half of the gains that we saw last month. So is it too early? It sounds like it for the Fed to declare victory on inflation. We want to bring in Max Kettner. He's HSBC Chief Multi-Asset Strategist. It's great to have you here. So first, your reaction to the print that we got this morning and what you think, if at all, this changes the calculus for the Fed.
Yeah, good morning. I don't think it changes the calculus for the Fed, let's say, upside down, but at the margin, it is definitely a bit more hawkish, right? So when we look at things like the super core inflation that you guys were just talking about, let's remember that also all sorts of, different kind of measures of inflation are also starting to pick up. So you look at, underlying inflation, super core and all that. You look at that on a three-month basis, or you look at it on an annualized 6-month basis. And it's all sort of looking like the last 2-3 months, it's been bottoming out and really starting to pick up again, right? So that's not good news for the Fed. It doesn't change the calculus for the Fed in the sense of like, oh, there's going to be no rate cuts at all this year. But definitely pushing a March rate cut through is going to be incredibly tricky, right? So March and May to me seem very, very, very unlikely with those kind of prints. Because remember, what we've not seen in that report, we see that in other measures. We're seeing, for example, in some of the company surveys that, things like output prices are starting to pick up, that compensation plans, wage plans are starting to pick up, right? So we're starting to see, underlying measures, median CPI measures picking up. We're starting to see, of course, supply chain pressures rising again with the disruptions in the Red Sea, right? We've started to see air freight rates going up at the end of 2023 anyway, before all the Red Sea disruptions. So it's pretty much across the board that it's not like we're seeing a massive second wave of inflation, but I think we're pretty close to actually the low end sort of core inflation. I think people are underestimating that, sort of 2.6, 2.7 handle in core inflation is perhaps the low end. We might be at risk of picking up then again.
Not a massive wave, as you mentioned, Max, but in some key areas where it is continuously sticky. How should an investor who's trying to read through this print here this morning, what is the first trade that they should be considering as they're looking at some of those stickier areas of inflation? Yeah, it's the dollar. It's long dollar, right? This really calls for a long dollar environment. And this is extremely different from the last 2-3 months ago. Because remember, in the last 2-3 months, think about what happened in the last 2-3 months. We've seen essentially a rally across everything. Imagine if 3 months ago you had said, I am massively bearish. I'm long the Japanese yen. I'm long gold. I'm buying 30-year treasuries. So essentially, you're buying all those sort of typical safe havens, right? What we call typical safe havens. You would have been equally as correct as if you'd been like, I'm actually massively risk on. I'm very optimistic, very bullish. So let me buy high yield and equities and emerging market debt. But both rallied in tandem, right? Everything got swept higher by lower yields. But the point now is when we look at these shorter term inflation expectations, what the swaps market is pricing in. So what shorter term inflation expectations are priced like in the market, they've massively, massively dropped over the last 2 months. Just to give you an indication, in the Eurozone, about 3 months ago on the 1 year part, right? So for the 1 year inflation expectations,
we were talking about a 3 handle. Now that's down to 1.5% in the US. We were talking about 2.6, 2.7% for a 1-year inflation expectation that markets were projecting. Now that's already below 2%. So given those really low near-term inflation expectations already, it was at least at risk of partially that broad-based rally unwinding from the last 2-3 months. And in that environment, what works is long dollar.
So, Max, when it comes to the volatility that we could see, or maybe this trading almost sideways here until we get another data point confirming that maybe the Fed could potentially cut rates, I guess, what does this report signal to you about the appetite for risk and some of the moves that we might see play out in the markets here over the coming weeks?
Yeah, I think over the coming weeks, I'm not too optimistic, right? So we were very, very bullish really on equities, on high yield credit, on emerging market debt, really across the risk spectrum for most of last year. But this is the first time since the beginning of last week where we're sort of hitting the pause button a little bit on risk assets, simply because things are starting to look a bit shaky on the inflation side, right? It looks like we've overdone this a little bit too much in the short term. And in terms of the sort of risk appetite that you've asked about, when we look at our aggregate sentiment measures and positioning measures, which is sort of a mix between discretionary and systematic positioning, right? So how fund managers are positioned, how they're viewing the world, how they're positioned in terms of the broader risk on, risk off spectrum, but also systematic investors. So things like risk parity or volatility target funds or CTAs. The crucial thing right now is not only has sentiment and positioning become much more stretched compared to 2.5 months ago, but it's also broad-based, right? It's not just one particular part of the investor community where positioning is a bit more stretched. It's really across the board where sentiment and positioning is a lot more stretched, and that argues for risk appetite to be a little bit lower, I think, over the next couple of weeks, and that we're at risk of seeing at least a little bit of a correction, right? And of that broad-based rally across everything, right? That at least being partially unwound in the next few weeks.
What do you believe the worst thing is that CEOs can signal about the economy right now, even outside of the economic data that we might be seeing come through and still looking for a trend to be locked in for the Fed? What is the thing that you would be watching for this earnings season?
Yeah, look, on the reporting season, the consensus is actually for an almost 8% decline quarter over quarter for earnings, right? So it's very, very pessimistic. Again, at the moment, you're sort of in a lose-lose position, because when you look at things like earnings revisions against global equity performance, then the global equity performance has already baked in a lot of good news. So even if the reporting season does actually surprise to the upside meaningfully, which I think is entirely possible, right? Absolutely possible, given how strong actually, again, Q4 was from a top-down side. But the problem again now is on the inflation side, right? We're now expecting a March rate cut, right? The market is now really starting to say, oh, they're going to have to cut in March. And if not, then it has to be May. So the problem is, even if the reporting season does turn out to be better, and even if CEOs actually do start to say, look, our guidance is improving, things are literally really picking up, right? That actually could be, in some ways, as perverse as it sounds, it could be pretty bad news from a market perspective, because it really does take off some of those Fed rate cuts, and it does call into question that valuation-driven rally that we've seen in Q4.
Max, always a pleasure to get some of your insights here. Thanks for helping us break down what investors should be watching for, especially coming off of this CPI print. Max Kettner, HSBC Chief Multi-Asset Strategist. Great to see you. Thanks. Well, a milestone moment for Bitcoin. Regulators have given money managers the approval to launch 11 spot Bitcoin exchange-traded funds. Now, everyday investors can get exposure to the world's largest cryptocurrency without having to own it. There's a lot of optimism around the news that we heard from Coinbase CFO Alessia Haas last night. Here's what she had to say.
I believe very strongly that crypto is the future of money, and this is going to introduce more people to crypto and eventually the crypto economy. And we think it's a first step of many on their journey into the crypto economy.
Yahoo Finance's Rochelle Akufo is here to weigh in. Rochelle, so what does this mean for investors and for the next crypto ETF on deck?
Well, certainly a lot of potential here. I want to set the stage here by saying FOMO is not a strategy. Don't get caught up in this. If you weren't already a Bitcoin enthusiast, don't feel like you have to launch into this. But now that we do have these approved ETFs holding physical Bitcoin as their underlying asset, investors do have some comparing to do. So launching 11 spot Bitcoin ETFs means competition for fees. You see, Grayscale has the highest fees. They actually did have first mover advantage by having their trust set up back in 2013. You also have other factors, including liquidity and fund trading costs. Now, if you're a buy and hold investor, you'll likely focus on the fees. Active traders more likely to focus on liquidity. Something to note, though, ETFs traditionally haven't had as much volatility as an asset like Bitcoin. But this is a very important first step. As you mentioned there in that soundbite there, Bitcoin's ETF custodian Coinbase laid that out when we spoke to their CFO. But for context, according to Morningstar US Market Index, they found that over the past 5 years, Bitcoin's standard deviation of returns is nearly 4 times that of the US stock market. But now you have these floodgates that are open, and of course, all eyes then on the next biggest crypto asset in terms of value and trading volume, and that is Ethereum. Now, just to differentiate, Ether is the actual token. Ethereum is the blockchain network or the smart contract technology that it runs on. And of course, SEC Chair Gary Gensler throwing cold water on the potential for an Ether ETF, saying Bitcoin's ETF approval should, quote, in no way signal the Commission's willingness to approve listing standards for crypto asset securities. So this is a very different product from Bitcoin. And of course, keep in mind, it took a decade for Bitcoin spot ETF to begrudgingly get that SEC approval. But even as you look at the performance of Bitcoin and of Ethereum, it's a very different story than when you look at some of the other altcoins and stablecoins that haven't fared as well. So tempered expectations here. And of course, don't get caught up in the FOMO, of course. Back to you guys.
Yeah, Rochelle, and this is so interesting. I was speaking with Alicia Haas, the CFO of Coinbase, right after we got this approval last night. And she was talking about the fact that this is a massive moment here for the crypto industry, calling it a landmark decision here for the industry, for her business and beyond, and what this is going to do for future interest and maybe drawing in some of those investors who had been a little bit nervous about investing in crypto, investing in Bitcoin in the past because of everything that has happened within the industry over the last several years. I'm curious from your perspective whether or not you think this is going to be an inflection point for crypto when you look ahead to 2024. If we do see some success from the launching of these ETFs, if we do see these ETFs generate a ton of interest from investors that maybe did not have crypto exposure before, what do you think that then is going to signal to us just about future products, how popular they will be, and how many more people would then be allocating some positioning within their portfolio to crypto?
I mean, it's tough because this is obviously a first case scenario here. As you mentioned, this is a landmark decision here. So this will really set the tone for what happens. And it could perhaps open the door to perhaps what we might see with Ether or perhaps some of these other altcoins. But as we saw there, the SEC clearly gave this approval begrudgingly, as we saw from Gensler's comments here. But as you look at how spot Bitcoin ETFs have performed in Canada and other parts of Europe, we didn't see a huge upswing for Bitcoin. We didn't see a huge propagation of more Bitcoin spot ETFs coming to the fray. But I think when you have such huge institutional investors, such huge money managers, of course, in Grayscale and others, it does perhaps give it a bit more credence than some of these other spot Bitcoin ETF launches, Shauna.
Yeah, well said, Rochelle. You know, two things that I wanted to add around this, because now it is about the listings that are coming forward here on the day. We got a statement from Nasdaq this morning, of course, over at Nasdaq, ringing the opening bell. You're going to see iShares and BlackRock with iBit, which goes public today. And it took me back to my days of publishing equity trader alerts over at the Nasdaq. But that aside, and the little walk down memory lane, the listings that are coming forward, you're going to see iBit, and then additionally Valkyrie. That's going to go public on Nasdaq. BRRR is the ticker symbol there. And then additionally, of course, our conversation that we're going to be having with Michael Sonnenschein of Grayscale, GBTC is the one that's going to be converted. Julie Hyman's going to have that conversation. Plus the Wisdom Tree folks, they confirmed that there's BTCW. That's going live at market open. So all of these considered, these are the listings that some of the investors are going to be watching closely coming forward today. And after all of the press releases and the volume has moved forward here, it'll be a longer question of what's the long tail for some of this too, Rochelle, right?
It's true, because a lot of this it comes down to buy and hold investors. A lot of people who are investing in these ETFs aren't going to be the ones who are doing a lot of this active trading. But as you mentioned, it has opened the floodgates here. People will be comparing on fees, on liquidity, on some of these funding costs as well. So we'll see if having first mover advantage really benefits, or if it'll come down to some of the nickel and diming that people will do as they try and count their costs while they still want exposure to what is a very volatile asset in Bitcoin, guys.
All right, Rochelle, thanks so much for breaking that down for us. Let's get to another big story of the day, and that is the stock to watch, which is Citi, issuing a stark warning. The bank disclosing billions in one-time charges and reserves to investors ahead of its earnings report tomorrow on Friday. Shares moving lower ahead of the open. We're looking at losses of nearly 2%. We could be looking at losses at 2% here at the opening bell. Yahoo Finance's Madison Mills has the details. And Maddie, this is so significant because of the timing of this disclosure coming before the report that we're getting tomorrow morning.
The SEC requires these companies to issue as much forward guidance as they can. And on December 6th, the CFO, Mark Mason, had said that these losses on the balance sheet would come to the tune of a couple $100 million. Change that M to a B based on this SEC filing here because of two big losses that Citi is citing. One is $880 million related to currency conversions from the Argentine peso. The other is $780 million related to CEO Jane Fraser's efforts at restructuring. Now, that $780 million, that could be something for investors to take a look at because the firm could be taking on some costs in an effort to cost cut, which could benefit this name moving forward. And that's exactly what Wells Fargo's Mike Mayo is saying. He's saying that this is actually a name to potentially invest in because there's basically nowhere else to go but up. He says that Citi stock could double over the next 3 years because of where they're at right now. And I just want to take a look at how this stock is doing in comparison to the others. The entire bank sector down this morning, probably in anticipation of those bank earnings to come tomorrow with JP Morgan. Citigroup down 1%. They are almost among the biggest laggards in this space here. Goldman was down about 2% this morning. I'm looking at the live numbers here, though, getting a little bit of relief from Goldman here, seeing on my side that Citigroup is down the most in this morning's trade. So getting some dings to this name because of the losses on their balance sheet. However, CFO Mark Mason is saying that they are not planning to change their strategy moving forward. They're going to continue along the exact same train that they have been, that this restructuring is going to be a benefit to this name moving forward.
Maddie, thanks so much. We're going to be watching this closely as we get into the trading activity. We're just minutes away, taking a quick look at futures, about 10 minutes from the opening bell, 8. Coming up, we're going to be wrapping up a busy week here at the Morning Brief. Yahoo Finance live at CES in Las Vegas. And we can't forget, of course, Friday's big kickoff to earnings. We got big banks plus a little bit of airlines with Delta. We've got you covered on all of it. Catch us live on Yahoo Finance's Morning Brief. Welcome back. We're just minutes away from the opening bell on Wall Street. Taking a look at stock futures here this morning. You're taking a look at the Dow, the S&P 500, and the Nasdaq. And for right now, the Dow and the S&P 500 about as flat as it gets. The Nasdaq futures, they're up by about 0.1%. So we'll see if there's any concerted move one way or the other as we get into that opening cross. It's also time for today's trending ticker. Amazon's $1.4 billion deal to buy iRobot in May may be in jeopardy. The tech giant missed its deadline to file remedies which could have aided any issues with antitrust enforcers in the EU. There you're taking a look at the shares of both Amazon and iRobot. iRobot would have perhaps the more pronounced move here, but Amazon missing that key deadline here, and especially within the EU, where the EU has had a history of being more strict about enforcing some of the rules with the U.S. big tech companies that have sought to do more business or expand within the region.
Yeah, Brad, I think taking a step back, this also is bringing up the questions just about future M&A, what exactly that's going to look like more broadly speaking within the tech sector, especially when you have a couple or a handful of names that really control much of the market here in terms of customer money that's being allocated to their businesses and the rapid growth rate that we have seen in so many of these companies that are leading the way within this space. So the fact that we are running into potential regulatory issues here by the EU for Amazon's deal with iRobot just brings up what exactly future acquisitions or future buying plays could potentially look like beyond Amazon and within the sector. But like you said, we have seen Europe time and time again really come out on the forefront with their crackdown on big tech, especially larger tech U.S. companies, being a bit more strict in terms of some of their anti-competitive behavior, what they would classify as their anti-competitive behavior. So initially we did see a huge move to the downside here in iRobot stock, and now we're looking at, looks like it's actually trading to the upside here in futures, which is an interesting move. But again, lots of questions just about that $1.4 billion bid for iRobot, which now seems to be in jeopardy given the fact that we are getting these developments out of the EU.
Yeah, the EU particularly on this, and the Commission had said that Amazon may have the ability to foreclose iRobot's rivals because Amazon's online marketplace is a particularly important channel to sell RVCs in France, Germany, Italy, and Spain, and customers in these countries, particularly, they rely on Amazon both in terms of product discovery as well as for their final purchasing decision. So that comes back to the competitive nature of the environment that you were just mentioning.
Yeah, and it's also pointed out, we were just looking at that futures board with the stock rising just about 2%. It is on the heels, though, of that 19% decline that we did see yesterday. So again, putting that in context, still down huge since we did get this report yesterday when you put all of that in context to some of the moves that we're seeing now.
That's right. Well, we've also got some big news in the energy space this morning. Chesapeake is set to become the top U.S. natural gas producer as it announces it will buy smaller rival Southwestern Energy in an all-stock deal that's worth about $7.4 billion. Chesapeake shares rising almost 3% on the news. Southwestern falling right now by about 2% here. Some of the transaction highlights that the company is pointing out, Chesapeake Energy at least, they say that it's going to be combining high-quality, large-scale acreage in Appalachia and Haynesville, and the company pro forma has a current net production of approximately 7.9 7.9 billion barrels per day. Well, not barrels per day, but more than 5,000 gross locations, 15 years of inventory, and synergies of approximately $400 million, some of the figures that they're tossing out there right now.
Yeah, Brad, this is going to add to their onshoring efforts here in the U.S. Estimated 5,000 drilling locations, providing 15 years of drilling inventory. And it's also a continuation of the theme that we've seen play out within the energy space, something that we have talked to strategists time and time again here at Yahoo Finance over the last several months about more consolidation within the industry, especially coming off of the massive gains that we saw from many of these big energy giants here over the last 18 months or so. So they're looking to put some of that capital to work. They're doing it through M&A activity. Remember, Exxon buying Pioneer, Chevron buying Hess, Occidental scooping up Crown Rock in just the last several months. So this is the latest deal for the energy space, and you see Chesapeake here really making a move in order to expand some of their exposure with a Southwestern here. The acquisition of Southwestern Energy expected to more than triple Chesapeake's approved reserve base and nearly double production.
Just one quick reaction that we got actually out from Fitch Ratings on this. Their rating watch reflecting the reasonable valuation of the all-equity transaction and saying the scale and metrics of the combined entity are commensurate with an investment-grade rating here with strong gas positions in Marcellus and Haynesville plays there. We've also got the opening bell coming up here on Wall Street. There you're taking a look at the Nasdaq and the New York Stock Exchange. Shauna, just a milestone occasion that we're witnessing here today.
A massive occasion here. And again, when we talk about the influence of what exactly this is going to have on the crypto market, more widely speaking, more broadly speaking, it was highly anticipated, that decision that we got last night from the SEC. Now exactly how this plays out, how much interest we're going to see amongst investors is something that we are going to be closely tracking here at Yahoo Finance. But also let's take a look at the equity markets, because remember, we did get that CPI print just about an hour ago, slightly hotter than expected. Jared Blickery standing by at the Interactive with a closer look at some of the moves that we're seeing, Jared.
Hi, I was just looking for this first Nasdaq print, which we got a second ago. Nasdaq up about 1/3%, and the S&P 500 up 1/4%. Dow right there with it. And interesting to see stocks opening positively, because just a few minutes ago in the pre-market we saw that initial downdraft. But here's what the S&P 500 has done over the last 5 days, up over 2%. It is just within a hair of its all-time record closing high, and intraday high for that matter. We'll have to see how that develops. Just taking a look at the sector action today, we have tech that is in the leader spot. That's up 0.75%, followed by energy and communication services. Real estate is the biggest loser here, down 0.8%, along with utilities and healthcare, by the way. Interesting to see that happen, because those have been the leaders up until yesterday. We saw a resurgence of the mega cap and the Mag 7 trade yesterday. But let's get a check on the crypto market here. We have some ETFs that are just starting to trade today. Don't pay attention too much to the returns here. But for instance, let's take a look at iBet. We can see just not really any trading history just yet, which is kind of what we'd expect, but we'll be checking on that to see how the trading in these ETFs develops throughout the day. Also taking a look at Bitcoin itself, that is up 5%, and what a rocky 5 days. By the way, I believe this is the highest in years, and we can see over the last 5 days, yes, here is the decision that we got. Well, it ended up being a false decision just a couple days ago. Here was the real decision, and off to the races here. Let me put a 5-year chart so we can really see some of the price history that we're bumping up against. You got to go all the way back to 2021, and there is a lot of price memory there. So going to take another catalyst, perhaps. Could it be the Ethereum, spot Ethereum ETF? Hard to say, but Ethereum itself is up 9%. And just taking a look at some of the other tokens here, by far and away, Bitcoin looks like not quite the biggest here, but some big gainers in the crypto sphere, guys.
All right, we're going to continue to monitor that, and discussion coming up. Yahoo Finance reporter Jared Blickery. Well, with what we mentioned, let's go to Grayscale spot Bitcoin ETF that is launching trading at the open. Shares hover near 3%, historic milestone for the crypto industry. Yahoo Finance's very own Julie Hyman standing by at the New York Stock Exchange with Grayscale CEO Michael Sonnenschein with that first post conversation here. Julie.
Hey there, Brad. Thanks so much. And Michael, thank you so much for being here. We've been talking for a long time about this. You have been working on this for a long time. So first up, how do you feel right now as you're standing in front of this and watching the opening prices?
I have never been more excited or prouder of the work that the Grayscale team has done. And I really just have to take a moment and thank all of our investors over these last 10 years. They've been extremely patient. They've supported us, and it's honestly not without their support that we would be here on the floor today trading on the New York Stock Exchange.
So obviously your product existed before as a trust, right? Has traded for a while here. So you have an advantage in terms of size. You come out of the gate with the biggest in terms of assets. You started trading early this morning as well. On the flip side, you guys have the highest fees out of the gate amongst this new crop of spot Bitcoin ETFs. So what does that competition look like? And, what does that path look like for Grayscale?
Yeah, Julie, it's a great question. I think there's 3 things to say about fees. So number one, we made a commitment to our investors that we would lower our fees. I've come on the show countless times talking to you about it. We made good on that promise, and we've reduced fees by 25%. Number 2, investors should have choice, right? There are 11 spot Bitcoin ETFs coming to market today, and it's really not without GBTC, the lawsuit that we won, that we would not have otherwise forged ahead and made a path for all of these products to come to market. And 3, to your point, GBTC is differentiated. It brings a market value to investors that I think they know and appreciate. It has $28 billion of AUM coming to market today. That means it is the second second largest spot commodity ETF in the world. Yesterday, it traded over $650 million notionally. And so while some investors, may look at fees from a differentiation perspective, GBTC has size, liquidity, AUM, and it's offered by Grayscale, a crypto specialist.
Something else I wanted to ask you about is you've had a lot of investors who have been in GBTC for a while, waiting for this moment, waiting for the discount to close as well between GBTC and spot Bitcoin. Do you think some of those folks will now be getting out of the product?
No, I think for many investors, and because GBTC has been trading since 2015, we've had investors come into our fund on days, we've had investors come out of our fund on days. The same will be true with GBTC now being an ETF. We're actually more focused on inflows and growing the fund. Having GBTC trade as a NYSE ARCA listed ETF really opens the opportunity to a much broader base of investors that have been waiting for the protections of the ETF wrapper.
So that brings up my next question, which is, who is your core audience? There's been a lot of talk about all the different constituencies out there. Who's the best fit for a GBTC versus some of the other ETFs?
Well, let's start with the investment case, right? Bitcoin is multidimensional, and so it could be an individual who's buying, Bitcoin exposure directly, whether it's in a retirement account or a brokerage account. It can certainly be this new audience that we're excited about, financial advisors, folks that are designing asset allocations for their clients, and it could certainly be institutions as well who really will look to products like GBTC that has leading liquidity, and they can put positions on and off without ultimately affecting the share price directly. And so I think it's exciting to see that so many different types of investors would be interacting with GBTC as an ETF.
I want to talk a little bit about what people can expect in terms of price, right? We're looking at where it's trading right now, around 42.
Yep.
The price of Bitcoin is around 47,000, so it's 1,000th of that. How closely are they going to track, and how does that all work?
Well, this is one of the great things about the ETF wrapper, and one of the things that we've been so focused on and why we've been fighting so hard for investors to get to the ETF wrapper. The ability to have creations and redemptions of the ETF is what should create the arbitrage opportunity for authorized participants to keep the shares trading in line with the underlying Bitcoin that the ETF shares hold. And now that we're trading as an ETF, we expect that to happen.
Let's talk a little bit about cybersecurity, which was obviously thrown into relief the other day by the unauthorized tweet that went out on the official SEC X account. Cybersecurity, a big thing in the Bitcoin industry. We've seen hacks, we've seen thefts, et cetera. How are you keeping the Bitcoin safe?
Well, we have partnered with Coinbase Custody. They've been the custodian for GBTC for many years now. We believe they're a best-in-class custodian for the assets themselves. When I think about the last 24, 48 hours, it wouldn't be crypto if there wasn't some volatility. And so it's all been a little bit of a blur. But what I can say with confidence that cybersecurity is one of the things that we take as almost our highest priority at Grayscale, is the safety and sanctity of the assets that we administer on behalf of our investors. And we feel very, very confident in that regard. Again, this is one of the things that will continue to differentiate us. As a crypto specialist, Grayscale has been doing this for a decade. And it's wonderful that there are some other new issuers now in the market with similar products, but they're just at the beginning of that journey of what it takes, the complexities, the intricacies of running investment products in this new asset class.
There are a lot of your competitors who are using Coinbase as a custodian as well. Is there any concern that it's too concentrated, that risk then becomes concentrated when you have one central custodian?
Well, I do think over time we will start to see diversification amongst custodians. For a lot of folks looking at the custodial landscape, there are some other really great players in this space, and I think coming out of this most recent crypto winter, you may start to see some assets move around, you may see some M&A activity between companies, and that may mean diversifying custodians as well.
Finally, I want to ask you about another product that you guys have, which is Ethereum.
Yes.
Because there is some thinking now that this has happened, perhaps a spot Ethereum product can also be approved. What do you think?
Yeah, this is another place that I believe investors have been really patient in waiting for a spot Ethereum product to come to market. As you know, we run the world's largest Ethereum fund, the Grayscale Ethereum Trust, ticker ETHE. And so now that GBTC has fulfilled this very prescribed 4-phase life cycle, going from a private placement in 2013, now all the way to an ETF on the NYSE, it does pave the way for all of the other products in the Grayscale product family to continue along that phased life cycle. And obviously we filed publicly to uplist our Ethereum product to a spot Ethereum ETF as well.
Well, maybe I'll be down here in a few months talking to you again.
I hope
when
so.
that's happening. Michael Sonnenschein, thank you so much. Really appreciate it. And congrats. I know it's been a long road.
Thank you.
Back to you guys.
All right, excellent conversation there. Michael Sonnenschein, Grayscale CEO, and Yahoo Finance's Julie Hyman. Coming up on the other side of this short break in Yahoo Finance's Morning Brief, we're going to break down the top ways that you can play the latest inflation data. We've got Case Capital Advisors Kenny Polcari coming up next, and maybe a nice little recipe that he can dish our way.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief. Your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
Inflation data coming in slightly hotter than expected this morning. Consumer prices rising 0.3% on a month-over-month basis in the month of December, pushing the annual headline rate to 3.4%. So what are some of the top plays from this report as we see the markets react to the data. We want to bring in Kenny Polcari. He's a chief market strategist at Slaystone Wealth, joining us here inside. Kenny, it's great to have you.
It is so great to be here. I think this is so great. Beautiful new studio. It's perfect.
Your first time in our brand new studio on the Morning Brief. All right, Kenny, let's talk about the inflation print that we got out this morning. We're trying to break it down exactly what this means for investors, the top trades that they need to keep in mind.
So listen, I'm not surprised. We saw that little tick up. It was expected to be a tick higher, although it came in a little bit even stronger than that. And that just suggests that this fight against inflation isn't necessarily over the way the market had prepared us for, in the last 8 weeks of the year when they were talking about inflation's coming down and we're going to hit 2% and you got to buy everything. And we saw the markets rally. I think that investors need to just pay attention to really what the narrative is going to become. And again, it depends on who you are as an investor. Are you a long-term investor or are you a day trader that's looking for the daily volatility? Because if you're a day trader looking for that, you want to react to any headline that's out there, because anything that makes the market move is what's good for you. But as a long-term investor, you really have to sit back, right? This doesn't necessarily change my outlook on what to do and how to allocate funds and how to allocate assets at all. What it might make me do is just be a little bit more cautious and not chase things and be a little bit more patient. And any new money, I think, will be added to more defensive sectors like healthcare and consumer staples versus tech, which is on fire. Right? We still own it. It's still part of the portfolio. But I'm not going to chase it up here. I'm going to wait because I do think the market's going to pull back.
Does it make you hesitant to then trade a Fed cut at this point?
Well, yeah, but I was in the camp that the Fed wasn't going to cut all along. This idea that, they're going to cut 5, it's what started out as we're going to hold rates higher for longer, suddenly turned into, well, and we're not talking about rate cuts, suddenly turned into, well, we're talking about it. And then it suddenly turned into 4 or 5 rate cuts or 5 and 6 rate cuts, by the summer.
We haven't gotten the first one yet.
We haven't even gotten the first one yet. And today's data suggests that, that whole idea of March is probably going to get pushed back. But then also don't forget it's a presidential election year. And the Fed cannot be cutting going into a presidential election for the sake of being seen as political, right? And so the Fed's actually not supposed to do anything 6 months in advance of a presidential election, which really means if they're going to cut rates or if they're going to do anything, they got to do something between now and really May, right? Because after May, then you're too close to the election. Now, doesn't mean they can't. They can if we fall off the edge and there's a real reason for it. Can they always do it? Yes, they can. But if the economy remains the way we're going, which seems to be okay, unemployment's at historic lows and the consumer seems to be spending money like there's no tomorrow, then there's no real reason to cut rates. And by the way, remember, if you cut rates, you're stimulating the economy, which would then reignite potentially inflation.
Do you think, though, we're going to see a bit of a deterioration? We already started to see it when you take a look at the holiday sales number, when you take a look at a lot of those consumer discretionary plays under a bit of pressure there. Are we starting to see, though, that narrative, the fact that the consumer had been so resilient now for so long, starting to shift?
Listen, I've been saying that for a while. Yes, I think the consumer is stretched. And I think you're going to start to see that as, we get more news on credit card debt and credit card potential defaults. I mean, there are 10-year highs at the moment, credit card defaults and auto loan defaults. And I think that's only going to get more difficult because, look, even if the Fed cuts rates, Bloomingdale's and Nordstrom's and J.Crew are not cut. They get usurious 30% rates on their credit cards. They're not cutting those a penny if the Fed cuts rates. So there's really no benefit to the consumer. Rate cuts, okay, mortgages maybe, but how often do you buy a house? You buy a house every day? Right? You buying a house every season? No, you're not. So that's really not going to, and you're not buying a car every day either, or every season, or every 6 months. And so those rates, while they will come down, are not going to affect you as much as if you carry a balance at Nordstrom's or Bloomie's or Abercrombie and Fitch, wherever it is.
Well, that's the other component to this, right, is housing and the stickiness of inflation in the housing sector. And it was interesting what we heard from KB Homes even last night during their earnings report, saying that they're not going to necessarily, perhaps from their side, say a price mechanism be influenced or put into some of the purchasing decisions just in order to spur demand because they already have enough in backlog and they have enough in demand that they anticipate going forward, which is the other side of what the Fed does not have control of.
That's right. And so if that's true and rates have come down, we saw them tick at 8%, in October. They've now come back down. 30-year money, I think, is somewhere around 6.5. And if you go like for a 5-1 arm, maybe you're in the high fives now. So they've significantly come back. But in comparison to what they were for the last 16 years at 2%, a lot of people continue to think that they're higher when actually they're almost historically normal, right? When you think about it. So there needs to be an adjustment there. And I also don't though think there needs to be an adjustment in prices. Prices still have to ease back a little bit because taxes are going up, the cost of owning a home is going up everywhere you look, whether it's insurance, whether it's maintenance of the house, pieces of the house, air conditioners, and all that stuff are getting more expensive. And so it's got to balance out somewhere.
Do you think we'll see that though?
I think you're starting to see it in some places. Like I live in Florida, but I live along the water. So along the water, those prices don't really they don't come in. Yeah. They don't come in that quickly, right? But if you go further west into Florida, like on the other side of 95, you are starting to see some softness in the house because you're further away from the water, and they're building like crazy out there. So there will be more supply. So I think in certain areas you're going to start to see it.
All right, we're going to petition for a Yahoo Finance Florida Bureau so we can get a little bit closer to the
Come on down.
Come on down.
Kenny, great to see you. Thanks for joining us up here in the
Thanks
Northeast.
for having
Kenny
me.
Polcari joining us here live in living color in studio. Coming up, we've got more from Yahoo Finance's morning brief. We're going to break down the state of play ahead of Monday's Iowa caucus. That's next.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief. Your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
And actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's the morning brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
The Iowa presidential debate took place on Wednesday night with Ron DeSantis and Nikki Haley verbally sparring about their policies, former President Donald Trump's standing and Ukraine funding, but also trading insults. Let's bring in Yahoo Finance senior columnist Rick Newman to give us his insights on what took place and watching all the things so that the rest of us might not have to.
That's right. These debates are terrible, guys. You might think that since it's winnowed down to 2 instead of 6 or 7 or whatever we had at the beginning back in the summer, it would be better. But it wasn't really. I mean, it's like watching teenagers bicker for 2 hours. They're charging each other with arcane violations of this and that. You don't know what's true. You don't know what's not. I guess in watching these, you sort of get a feel for the style and the character of each candidate. So the pundits, this morning, a few say Nikki Haley won by an edge, a few say DeSantis won by an edge. So call it a draw. I mean, in terms of the issues that our audience cares about, to the extent you could get any information where they stand on actual issues, Ron DeSantis wants to decouple the U.S. economy from China. That sounds actually a lot harder to do than it might sound. Nikki Haley says be more targeted. Nikki Haley is willing to talk about reforming Social Security, starting with young people who might not get the same benefits as older people closer to retirement. Ron DeSantis basically saying, I won't touch Social Security. And there's a lot more for anybody who wants to watch the replay, but my advice is don't.
All right, so maybe we're not going to spend some time watching the replay. But, Rick, what does all this mean then looking ahead to Iowa caucuses? That's kicking off next week. Lots of talk just about some of those policies that you laid out in terms of what investors need to keep in mind as we look ahead and count down to November.
Well, thank God we're finally getting to the voting part of the campaign, with Iowa starting next week. And then we will be plunged right into it, and we'll get to Super Tuesday, which might be the definitive event at the beginning of March. So I think what to watch for in the Iowa caucus in terms of the outcome. I mean, this is always a weird day that doesn't necessarily predict anything about the rest of the election. Sometimes it's a kind of an outlier of a win. Sometimes the person who goes on to win the nomination doesn't actually do that well in Iowa. But the thing to look for is Donald Trump, obviously way ahead here. He's polling at about 54% in Iowa among Republicans. So I think we're watching to see, does Trump measure up? Does he get about that portion of the vote, or does he get something less? And I think if Trump gets less than 50%, then I think that would be an indication of some weakness for Trump. And then we go to New Hampshire the week after. Nikki Haley is expected to do better in New Hampshire than she is going to do in Iowa. And I think those two contests are going to tell us, does Trump have a lock on this thing, or is there some weakness and some room for one of these two other candidates, Nikki Haley and Ron DeSantis, to perhaps challenge Trump? And this matters a lot. I mean, for markets. I mean, there's a lot at stake in the 2024 election. The biggest thing is going to be tax changes, where some of the 2017 Trump tax cuts expire at the end of 2025. That mostly those are the ones, the tax cuts for individuals. And whoever wins in 2024, that is going to be decisive in terms of whether we get continued tax cuts for people, or there's some change, such as higher taxes on the wealthy, possible higher taxes on businesses and stuff like that. So as tedious as this all seems, it does matter.
All right, Rick Newman, thanks so much for breaking all of it down. Of course, we're going to be talking to you next week as we kick off Iowa caucuses. Rick, thanks so much.
Bye, guys.
Well, coming up next here on the Morning Brief, why technology may still be a top pick despite the fact that we've seen some weakness since the start of the year. We're going to talk to Brian Belsky of BMO Capital Markets on the other side of the break.
Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We're about 40 minutes into the start of today's trading session. Well, 31 to be exact. How things are shaping up? Let's take a look. The major averages, as you've seen here on the side of our screen, we've got the S&P 500 down by about 0.1%. This morning's inflation data showed consumer prices rose more than expected in December.
All right, and some of those individual names on the move. Coinbase, now it's actually lower, off just about 0.5% on the first day of trading for spot Bitcoin ETFs. We're talking about Coinbase, the crypto exchange, because it is the Bitcoin custodian for most of the filings that were approved by the SEC yesterday. Now, I spoke with Alicia Haas, the CFO of Coinbase, right after the news broke. She called it a landmark day for crypto.
And a downgrade from Wells Fargo, taking a bite out of Yum Brands shares today. The analyst Roger Reed cutting the stock down to equal weight from overweight, saying that the bullish thesis for the stock is largely played out.
And Chewy boosted to overweight at Barclays. The analyst there saying that he sees potential for outsized returns in the company's e-commerce business this year. He also believes that areas like its vet clinics and insurance could drive positive revisions longer term as those businesses scale.
Well, it's been a tough year for tech so far, starting with downgrades on Apple stock as analysts become concerned with the tech giant's iPhone sales. Then we heard from their rival Samsung, who warned of a 35% plunge in profits in its fourth quarter. Now layoffs at Google and Amazon. Should investors be worried about the sector? We've got Brian Belsky, BMO Capital Markets Chief Investment Strategist. So should investors be worried at this juncture? I mean, we're only 11 days into the calendar year here.
Yeah, let's just breathe a little bit. By the way, you know, the Smiths were a great band in the 80s. I'm aging myself, but have you heard that joke before, or no?
No, that hasn't, not live on TV, but yeah. You know, and Brad plays the drums, so maybe
so there you go.
Take after them in the future.
No, you know, there's a lot of different calls out there on tech, and you know, our work shows that, especially after the type of unbelievable performance we saw in 2022 on the downside and then unbelievable performance on the upside, you have to take a look at 2-year periods. And following 2-year periods like this that we've seen in technology since the great tech bubble, okay, typically and historically, the 80% of the time the next year we see positive returns. That's number one. But I think the most important thing that you talk about all the time on air is valuation. And we have found through our work that valuation, actually in technology especially, is a terrible predictor of future results. And in fact, we believe if you take a look at all parts of the financial statement, so balance sheets, cash flow, income statement, we've already seen a bit of a pullback in valuations, and tech is not stretched, and we're nowhere near any kind of bubble or froth.
That valuation point that you just made, is that tech specific, or do you also see that in other areas, other sectors of the market? In terms of it not being the best indicator?
Yeah, well, traditionally, it is not a very good indicator at all, especially for the stock market. Now, over a 5 to 10 year frame, yes, but over a 1 to 2 year frame, I mean, come on, we're talking about 11 days right now in the market. And we in this, you know, we have the attention spans of gnats in terms of investors right now. We have no holding period, so analysis. So when we take a look at a stock, an industry, a sector, in a portfolio that we run, we have the great fortune of running 12 for BMO, is that we look for 12 or 18 months, and we look positionally. So Apple, everyone likes to beat up Apple. Guess what I've learned? You buy Apple when it goes down. You talked about Google and Amazon cutting costs. That's exactly when you want to buy stocks, when they cut costs. There's been financial companies in 2023 that cut a lot of people, paid a lot of people down on Wall Street, cutting costs. That's exactly when you want to buy the banks. So you want to buy companies when they get, quote unquote, religion, become tighter with respect to how they're running their businesses.
When we think of some of the S&P 500 targets that we've heard for year end, how much of that will be driven by tech, or is there another sector that you believe is going to emerge as that leader?
Well, every year I try to sneak something through compliance on my year headpiece. And this year, when we talk about size and style, the heading is Everybody Love Everybody. Okay, Jackie Moon. And if you know your semi-pro pop culture.
Will Ferrell?
Yeah, exactly. So, that guy. Anyway, you want to own a little bit of everything. Yeah. Okay? So what does that mean? From a sector perspective, you want to own tech in financials. Tech's growth, financial is the contrarian value side of things, okay? Everybody hates the banks, they're believing they're going to zero. Now everybody thinks tech is over. So I think you need to be in value, you need to be in growth, you need to be in dividend growth, you need to be in small cap. Small cap holders, and we've been bulls on small cap now for a long time, now everybody's kind of coming around with us, but small caps, if you take a look at the entire small mid-cap universe, it equates to the total market cap of Apple. Isn't that amazing?
Yeah.
It is amazing.
Think about that. That's perspective.
Yeah. And puts everything in perspective. It also puts in perspective the moves that we've seen, the excitement that we've seen around the market. But Brent, when we talk about, you mentioned financials in there. Everyone loves to hate on financials.
Oh, yeah.
We got to bring up the Citi news that we did get out last night. Don't want to make too much of one headline or one update from one of the larger banks, but the billions that they have announced here, just in terms of reserves, in terms of the cost cuts that they see going forward here, does that at all change your thesis? Probably not, just about the larger financial sector. And I guess when you take a look at a headline like that, put that into context for our viewers.
No, because typically and historically, when banks over-reserve, they traditionally are too conservative at the wrong time. They should have been conservative maybe a year ago. And now we've seen massive restructuring in Citi, new management. That's exactly what you want to see. And from an institutional perspective as well, we own JP Morgan in some dividend growth portfolios, but we switched a lot of our JP Morgan into Citi because I think that JP Morgan has to absolutely nail its results, because everybody's kind of counting on that stock, where Citi, people are like, nah, well, I don't really know, and not a lot of institutional sponsorship in Citi. So I think that Citi is more of a contrarian name here.
So with that much Goldilocks that's in the tape right now, then what should investors be bracing for at this point?
Well, I think, you started off this right at the end of the hour, talking about politics. I think politics are going to cause some volatility, especially the first half of the year as we kind of follow through with the caucuses and the primaries. Some reactionary, maybe think of it as a mini 2016. Remember 2016 was very volatile. We had Brexit.
Yeah.
Everybody thought that was very bad. And then we had the election, which was a flip-flop. And so I think we're going to have some volatility in that. But I think the second half of the year could be a lot better, because what we're seeing in our work, that earnings are going to be really good. Remember a year ago, nobody believed in earnings and they beat everybody. Now again, this year it's like, oh, the expectations are too high. No, actually, from a revision standpoint, we're seeing revisions start to come in, and the earnings expectations, especially for the areas that I think are going to drive the market, which was part of your question, technology, and financials, but don't discount the consumer. Consumers still doing great in areas like communication services with respect to the Googles and the Netflixes still have a lot of earnings power.
All right, Brian Belsky, always great to have you, especially when you're here in studio. Thanks so much for stopping by. We'll talk to you again soon. All right, well, coming up next here on Yahoo Finance Live, after a tumultuous week for Boeing, how are airlines faring? Taking a look at Boeing stock, at least off another 1.5% today. We'll have more on that. We'll be right back.
It's January and it's cold in New York City, so the Yahoo Finance team is packing up its skis and investing knowledge and heading to the Swiss slopes for the World Economic Forum in Davos. I know what you're thinking, folks. It's colder there in Switzerland, but myself, Julie Hyman, and the Yahoo Finance Live team plan to heat things up with some big-time interviews with the who's who of global business. The so-called Masters of the Universe will convene around the theme of rebuilding trust. There's no trust issues here. You can rely on us to ask the most important questions to the world's most high-profile leaders. Is the world more divided than it has ever been before? Is AI really bigger than the internet? Is this year's huge election cycle the risk we've all been missing? Will the bull market in stocks end really badly? You won't miss anything with our wall-to-wall coverage on Yahoo Finance Live and the Yahoo Finance platform, from top leaders in the banking, pharma, and crypto sectors to access the world's foremost academics and some policymakers for good measure. We've got you covered. Yahoo Finance's coverage of the World Economic Forum in Davos starts on Tuesday, January 16th. You don't want to miss it.
We're about 45 minutes into the trading day. Let's take a look at some of the home builder stocks this morning. We're going to get away from this yield for a hot second here, but taking a look at some of the activity here, I'm just going to rejigger the markets. So we've got that panel. And you know what? Let's just go straight to the heat map. Why not? Taking a look at some of the activity as of right now and toggling on over to the homes, as that was really one of the, actually was the biggest contributor to the inflation print that we got out this morning here. And so thinking about some of those names, as you saw KB Homes report earnings last night, that was one of the earnings calls that I was paying close attention to, because here, even as you got the CPI print this morning that showed half of inflation in December was, driven by homes here. Ultimately, there you're taking a look at some of the KB Homes results here, and shelter within this broader CPI print. It was interesting to marry both of these thoughts together. The last thought I'll put to this, the same factors that characterize the market today, low inventory levels, and then additionally solid employment, wage growth, those that they believe at KB are still going to sustain the longer term health of the housing market here. So ultimately here, even as we're keeping a close eye on some of the home builder stocks today, that is going to be one area to keep a close eye and tabs on as well going forward, everyone. Chana?
All right, Brad, let's talk about the big story that we have been following all week, and that is what has played out at Boeing. Alaska Airlines grounding all Boeing 737 MAX 9 planes through Saturday for inspections. Now, this comes after a door panel blew off of an Alaska Airlines flight over the weekend. So does Boeing need a manufacturing overhaul? And what is this also the pressure that we could see on airlines going forward? You're looking at Alaska Air off nearly 2% today. Our next guest saying that poor manufacturing has yet to be addressed. So let's break it all down exactly what this means for the company, for the sector moving forward. We have Mike Boyd. He's Boyd Group International CEO and President. Mike, it's great to have you here. So just your reaction to the fact that we are seeing a further grounding of these planes, and then the pressure that that could eventually put on some of these airline stocks.
Well, the real issue here is Alaska Airlines. Almost 30% of their airplanes are these grounded airplanes now. So if they have to stay down for any length of time beyond this weekend, we're going to have some major changes at Alaska to make up for it. In other words, they may stop flying to some small markets. Places like Kalispell and places like that might get hurt. But also they cannot be anywhere close to in the black when 30% of their airplanes are not being productive. That's one major issue. Even for United, it's a hit. It's about 11% of their narrow body fleet. The real issue here, we've got to have something coming out of the Boeing side that gives confidence again, not just to these two airlines, but to the flying public. We have a manufacturing issue, not a loose screw.
And so all that considered, is there anything in terms of an overhaul that you're watching for or expecting to come on the manufacturing side with Boeing?
I'm not expecting exactly anything. But again, we found the problem, bad manufacturing or sloppy manufacturing. That means someone has to go into Boeing and start to look at all aspects of what they're doing. This is not just a plug. So I would suspect we will see the NTSB or the FAA come out with something a little more serious than just, well, we found some bolts and they've tightened them.
So, Mike, if it is a manufacturing issue, that places even more pressure on Dave Calhoun to act. We've seen, obviously, in terms of his addressing of his employees earlier this week, the fact that he did seem rattled about what has played out over the last week. What do you think about his leadership so far and whether or not he's the right person for Boeing at this point?
It's a tough job. It's hard to pass on that. However, the response is often Boeing something like, well, we apologize. You don't apologize for this. You say, this is what we're doing. We found that there may be some shortfalls in some of the ways we produce our airplanes. We have the safest airplanes in the world, et cetera, et cetera. It's been really milquetoast up till now, and I'm not impressed. And I really do think, Boeing's board has to understand the shareholders have taken a hammering on this, and Mr. Calhoun has to come to the party like a leader, not like an apologist.
So, of what we've seen more broadly between the relationship between Boeing and the FAA, does this kind of put another spotlight on what needs to be rejiggered even within that relationship?
Well, you hit that one on the head because, it's very clear that the prior form of relationship between the FAA and Boeing and manufacturing in general prior to the MAX problems of 3 years ago, that has to change, which means maybe the whole relationship here has to change a little bit more. But yes, this does put a lot of pressure on the FAA not to let this kind of stuff happen again, because they ultimately are responsible for what Boeing is doing in so many areas. Same with the NTSB.
All right, Mike, let's talk about what was in the inflation print this morning. We did see a slight rise in airfare. There's been a big focal point on the pricing of airfare following the dramatic rise that we saw last year and then following some improvement. What do you think today's report, a slight increase here, but does that really tell us anything about the trends that we could see play out throughout 2024?
It's things other than the inflation, but I think it's starting to hit. Look, we're starting to see this bubble burst, and a 3-something% increase in inflation doesn't help it. But what we're seeing is leisure traffic is falling off. We've had carriers like Ovello found some of the markets that might be 90% full at Orlando 3 months ago are now 50% full. We're looking at a very soft Florida rental market. We just found out yesterday. So what we're looking at is we may be looking at some leisure travel starting to drop off, or I call it impulse travel dropping off. And that means some ULCCs, ultra low-cost carriers, may have to rethink. And it also means that we may not have the 7% growth that we were projecting just a week ago.
It's interesting because the public reaction as well to the Alaskan Airlines and ultimately the Boeing manufacturing issue that has now made its way from the dinner table to this set table and even conversations that we might have on the side, that has a broader sentiment impact on the flying public as well. But in the past, have we ever seen such an impact that it shifts how people travel to the point where airfare prices, and rounding this all together, airfare prices also see some sort of trickle lower?
Yeah, it's a triple or quad whammy, if you want to say. We have inflation making steak on the table more expensive. We have these stories about safety making issues with, again, at the dinner table. And then we have really, I believe, a downturn coming in the next 6 months of leisure travel. That's going to affect, a whole sector of the industry. And I don't think we're going to see the growth we thought we were going to think. All these things that come together, all of them are not necessarily related, but they all come to the bottom line. We may see a lot less air traffic in the first half of this new year.
Mike, always a pleasure to get your insights and some context around the playing out of this particular incident and event. Mike Boyd, CEO and president of Boyd Group International. Thanks, Mike.
Thank you, sir.
Yeah. Coming up, we're going to break down the biggest winners and losers in the food retail space. That's next.
It's like pineapple. What else is in it? Do we know? ChatGPT secret, I'm told. Yahoo Finance is on the ground here in Sin City, Las Vegas for CES 2024. I'm at the booth for Doosan Group, where this AI robot is about to make me a cocktail. I'm here with Stephanie Calloway. She is the senior marketing manager at Doosan. She's going to show me how this works.
Great. So this is Mixmaster Moody, our cocktail bartender.
Mixmaster Moody.
Yeah. So powered by Microsoft ChatGPT AI. It's going to tell you what kind of cocktail you need based upon your mood and facial recognition. So to go ahead.
Should I smile?
You can do whatever you want. Right. You can get angry, you can smile, you can look bored, whatever you want.
Okay, press start.
Okay, and then he's asking how your day is at CES. So exciting, amazing.
Chaotic.
There you go.
Right.
Camera's gonna turn on.
I look that way?
Yep, you're gonna look up there. You're happy.
Oh, I'm happy.
Do you feel happy?
Yeah, I feel okay.
All right, so then we'll go ahead and generate the cocktail for you. Takes about 10 seconds.
I'm analyzing my photo right now.
Your face, deciding.
Starting to determine I'm happy.
Yep. You're gonna get as joyful as you're. It's gonna start making it right now. For you.
Cheers. It's like pineapple. How does it determine what happy feels like?
So it's looking at all of the features of your face, your eyes, your nose, your mouth, the shapes that you're making. And it's associating that with predetermined recipes that would be associated with that feeling, that mood.
So we've essentially got a robotic bartender,
Yep.
right?
Yep.
Alcohol, non-alcoholic as well. It's a concept right now.
Correct.
We're going to see this in a bar soon?
Yeah. I think that in places where you've got high volume capacity, so whether it's a concert or an airport or something like that, it's meant to assist a bartender, right? So somebody who's moving and grooving and they're kind of behind the wheel, like this is supposed to help somebody make the volume go a little bit faster. So these robots are designed to be collaborative with humans and be in the workspace with them, and we're just really excited to take this one to market. It'll be fun.
It's January, and it's cold in New York City. So the Yahoo finance team is packing up its skis and investing knowledge and heading to the Swiss slopes for the World Economic Forum in Davos. I know what you're thinking, folks. It's colder there in Switzerland, but myself, Julie Hyman, and the Yahoo Finance Live team plan to heat things up with some big-time interviews with the who's who of global business. The so-called Masters of the Universe will convene around the theme of rebuilding trust. There's no trust issues here. You can rely on us to ask the most important questions to the world's most high-profile leaders. Is the world more divided than it has ever been before? Is AI really bigger than the internet? Is this year's huge election cycle the risk we've all been missing? Will the bull market in stocks end really badly? You won't miss anything with our wall-to-wall coverage on Yahoo Finance Live and the Yahoo Finance platform, from top leaders in the banking, pharma, and crypto sectors to access the world's foremost academics and some policymakers for good measure. We've got you covered. Yahoo Finance's coverage of the World Economic Forum in Davos starts on Tuesday, January 16th. You don't want to miss it.
Inflation data came in hotter than expected this morning, rising 3.4% year over year. One area that's been a particular pain point for consumers, the inflated food prices, which was reflected in the CPI report this morning. But how will this impact investors? UBS is out with its 2024 forecast, saying there are several near-term risks in the food space, but also long-term opportunities. Let's bring in Michael Lasser, UBS U.S. hardline, broadline, and food retail analyst to discuss more. Michael, perhaps we start there, and thanks for joining us this morning. Perhaps we start there with where the opportunities lie, especially as food inflation has been on the top of mind for both investors and for consumers right now.
Well, first, thanks for having me this morning. Number one, we think that a moderation in some of the inflationary pressures that have occurred over the last couple of years will allow consumers to spend more money on discretionary goods, things like apparel, home-related products, sporting goods. And that's important for a lot of retailers because they make better margins on those discretionary goods. Number two, with that being said, it is going to be a volatile year for the retail sector, both because of all the well-documented macro pressures, and this is going to be an election year. And it's going to be an election year that's likely to be very polarizing for at least half of the country, probably most of the country. This is also going to mean it's more difficult and expensive for consumer companies to talk with their customers because of a rise in media rates. So our best advice is to remain vigilant and disciplined when approaching investing in the hardline, broadline, and food retail sector this year.
All right, Michael, when it comes to some of the top plays or what investors need to keep in mind in terms of what this all means for positioning, what this all means for companies that maybe are in a better position to benefit from some of these trends that we are seeing, what are some of the top picks within the sector, and what do you think sets them apart from some of their rivals out there?
So number one, we like Target. Target has experienced a turbulent couple of years, but we think it's experiencing momentum that will drive both sales and profitability to improve in 2024. Some of the issues that it's faced are being over-indexed to the categories that are weak, and we believe that will become less of an issue this year as those categories like small appliances, consumer electronics, those start to stabilize and improve. Plus, its margins are well below where they've been in prior years, meaning it's got an opportunity to improve its profitability from here. Another name that we like a lot is Dollar Tree. Dollar Tree runs both the namesake brand as well as the Family Dollar business. Those businesses have been adversely impacted from a very tight labor market as it's been more difficult to attract and retain workers in those stores. We think as the labor market starts to experience some easing, that would actually be a positive for the dollar stores like Dollar Tree, not only because of its ability to better attract and retain workers, but also consumers will have to stretch their budgets a little bit more.
Yeah.
So those are two ideas that we would put at the top of your viewers' list of names to own within the retail sector this year.
And I guess Dollar Tree caught our attention in our meetings because in our, of course, recollection of the most recent earnings period, they basically missed on some of the expectations there, plus the outlook came into question. So all of that considered, what is the, perhaps, if there's a technical way to look at Dollar Tree, where is there still strength beyond just the consumer, and what type of mix do they need to then kind of rotate into the store in order to maintain that consumer that might be coming in because, to your point, there is more of a distress on the amount that they're spending?
So the issue that Dollar Tree contended with most recently was, number one, the mix to consumable items away from discretionary goods, and that creates a margin drag. And the other issue is shrink, the unexplained loss of inventory. We think both of those issues will improve in 2024. In addition, Dollar Tree has been implementing a variety of initiatives that will drive growth on top of that. Things like raising the shelf heights in its stores so it can carry more products, adding more multi-price point items in the namesake brand that drive traffic to those stores. So the combination of less pressure from those factors that were weighing on the business last year, along with better results from some of the initiatives it's putting in place, will drive Dollar Tree shares higher this year.
Michael, just lastly, while we have you, how big of an overhang for the food industry and food retail specifically, how much of an overhang is there driven by Ozempic and other weight loss GLP-1s?
So the verdict is still out on the long-term ramifications of anti-obesity medications on the consumption of food in the United States. Obviously, for those who are on it, that has a negative impact on their consumption of calories. With that being said, if you one way to look at it is that maybe 30 million people will be on a anti-obesity medication in the coming years. That's about 10% of the U.S. population. Perhaps those folks reduce their calorie consumption by 20%. So that's a 200 basis point hit to calorie consumption. In theory, that will happen over a multi-year period. So the point here is that while that will be a headwind, that will be a manageable headwind for the industry. Plus, we think if indeed it's more intense than what we are expecting, that would probably lead to some consolidation, which would create opportunity for the large, well-positioned players to gain share within the food retail space.
All right, something we will watch out for here in the months and years ahead. All right, Michael Lasser, always great to have you. UBS, U.S. hardline, broadline, and food retail analyst. Thanks so much, Michael.
Thank you.
All right, well, coming up, we have been live in Las Vegas all week, bringing you the latest from CES. We will be hearing from the CEO of Mobileye right after the break. We'll be right back.
Like pineapple. What else is in it? Do we know? ChatGPT secret, I'm told. Yahoo Finance is on the ground here in Sin City, Las Vegas for CES 2024. I'm at the booth for Doosan Group, where this AI robot is about to make me a cocktail. I'm here with Stephanie Calloway. She is the Senior Marketing Manager at Doosan. She's going to show me how this works.
Great. So this is Mix Master Moody, our cocktail bartender.
Mix Master Moody.
Yeah. So powered by Microsoft ChatGPT AI. It's going to tell you what kind of cocktail you need based upon your mood and facial recognition. So to go ahead.
Should I smile?
You can do whatever you want. Right. You can get angry, you can smile, you can look bored, whatever you want.
Okay, press start.
Okay, and then he's asking how your day is at CES. So exciting, amazing.
Chaotic.
There you go.
Right.
Camera's going to turn on.
I look that way?
Yep, you're going to look up there. You're happy.
Oh, I'm happy.
Do you feel happy?
Yeah, I feel okay.
All right, so then we'll go ahead and generate the cocktail for you. Takes about 10 seconds.
So I'm analyzing my photo right now.
Your face, deciding.
Starting to determine I'm happy.
Yep. You're going to get a joyful azure. It's going to start making it right now for you.
It's like pineapple. How does it determine what happy feels like?
So it's looking at all of the features of your face, your eyes, your nose, your mouth, the shapes that you're making. It's associating that with predetermined recipes that would be associated with that feeling.
So we've essentially got a robotic bartender, right?
Yep.
Alcohol, non-alcoholic as well. It's a concept right now.
Correct.
We're going to see this in a bar soon?
Yeah. I think that in places where you've got high volume capacity, so whether it's a concert or an airport or something like that, it's meant to assist a bartender, right? So somebody who's moving and grooving and they're kind of behind the wheel, like this is supposed to help somebody make the volume go a little bit faster. So these robots are designed to be collaborative with humans and be in the workspace with them, and we're just really excited to take this one to market. It'll be fun.
I'm Akiko Fujita here on the ground in Las Vegas at CES 2024, where there's certainly been a lot of conversation about autonomous driving. We are joined by Professor Amnon Shashua. He is the president and CEO of Mobileye, right in the center of that conversation. It's great to have you here today.
Great to be here.
You've had a string of announcements here on the ground, one of those being the driving experience platform, the DXP. You've kind of described it as a type of operating system for a car like Polestar. How does it work?
So, Mobileye is a supplier. We're talking about very complex systems that involve multiple cameras, about 11 cameras, imaging radars, LiDARs, very heavy compute. So it's a big chunk of the car. And the car maker naturally wants to control important aspect of the driving experience, not treat it as a black box. On the other hand, for Mobileye, customizing a system per customer would be difficult for scaling. So we found a way in which we can build a system, basically build only the infrastructure of the system, which is one that fits all, and allow the car maker to write code on top of our system to control the driving experience. So I'll give you an example. We divided the world into what is universal and what is unique. So for example, controlling the car is unique. HMI is unique to the car maker. perception, on the other hand, is universal. There's no reason that a BMW or an Audi or a Hyundai will have different perception engines, because the role of perception is to understand the environment, and you need to understand the environment to a certain accuracy that will enable autonomous driving. So there's no differentiation there. But then comes the driving policy. Driving policy is all the code that is related for decision making of the car. When to change lane, how to negotiate with other road users, the braking profile that you use, all of this controls the driving experience. Driving policy contains a lot of AI, a lot of validation, a lot of data-driven processes, and customizing this per car maker would be a nightmare. So what we found out is that we can take the driving policy and separate it into the universal and unique. The universal part is what we code, this is the operating system, and the unique part is what the car maker codes on top of our universal infrastructure. And in that way, create a system that can scale to all car makers.
So allowing the brands to customize according to their brand. There's certainly been a lot of negative headlines that have played out here in the US around autonomous driving. The biggest one being GM's Cruise. They've also had to halt all operations after the incidents that have happened in San Francisco. I realize Mobileye is not involved in that, but I'm curious what the conversation has been with some of your clients. Has this given them some pause in terms of how they integrate this technology in their cars?
I think the story of autonomous driving, there are three stories there. One story is safety. Another story is buying back your time. Say traffic today is congested, you sit quite a long time in a car, you'd like to do something else while you're going from point A to point B in your car, right? Now, use your smartphone, for example, or read a book, right? So buying back your time. The third story is using the car as a resource, right? So like an Uber, like ride hailing. So the story of Cruise and Waymo is only the third story, the story of using the car as a resource. Mobileye is active on all three stories. So for example, safety, for safety you don't need hands-free. For safety you want a system that observes 360-degree everything around you, understands all this and has a situation awareness of everything that happens around you, and then prevents you from making a mistake, prevents you from hitting a pedestrian, prevents you from, if another car is getting closer to you, your car will offset. If you are getting close to a car with an open door, your car will offset. If there is an obstacle, your car will do kind of a evasive maneuver. So this raises the safety levels to a very, very significant degrees. Once you have the safety, you can start allowing the driver to have hands off. So this is the second story of buying back your time.
But when you talk about, you don't necessarily need to be hands-free in order for safety. Is that where you think the real use case is going to be in this technology? I mean, so much of the attention has been about level 5 autonomy.
That's right. But because they focus only on the third story. The first two stories have significant value proposition. The safety story is a very significant value proposition because it saves lives. The second story of buying back your time. So if you have an eyes-off system in a consumer car, you are driving from San Francisco to Los Angeles, and 90% of the time you're on highways. And on a highway, the system allows you to, give control to the car. And legally, you'll be able to do something else because it's an eyes-off system. This is a significant value proposition because time is important, right? Because you want to do something else while you're driving. The third story is about using the car as a resource. This is the Waymo and Cruise story. And I think that the public is aware only of the third story. It's not aware of the first two stories that are very significant in terms of their value proposition.
So if that third story has gotten a lot of the attention, has been the first chapter, let's say, in autonomous driving, how does a platform like Supervision for Mobileye, how does that get you to the next story? What are we talking about here?
So the Supervision is the first story and half of the second story. What I mean? It is a system that has 360-degree situation awareness. It has 11 cameras around the car, so it understands everything around you, and can provide a layer of safety. Provides a layer of safety way beyond any driving assist systems that exist today. It also provides you a hands-free experience, provided that you are alert, that you are supervising the system.
How do you ensure that?
So there's a driving monitoring camera watching you, and if your gaze is on the road, the system will allow you to drive hands-free. Otherwise, the system insists that you hold the steering wheel. Right? So it's not the second story of buying back your time because you are supervising the system, but the driving becomes much more relaxed because the car is driving itself. But really, the biggest story there is safety. The step up beyond supervision, which we call chauffeur, is adding few more sensors for redundancy, like a LiDAR or imaging radar. And then you define certain road types or certain conditions, say for example, highway driving, where you can then legally have eyes off, right? That's the second story, and that's also coming out in about 2026. Those are the announcements that we made with the Western OEM. 9 car models are going to be equipped with the chauffeur system by 2026. Polestar is going to be equipped with chauffeur system in 2026. FAW, a number of models in FAW of China will be equipped with that. So this is really the next step coming out.
Very quickly here, a macro question, because you are in touch with the biggest car makers that are out there. Are you seeing a bit of a pullback in terms of the investments that they're making in the technology side of autos, just given where things have been? Or are you finding that they are still accelerating some of those investments because where the market is going?
Yeah, I think it's the opposite. If you look at the gross margin of a car, especially in electric cars, it's very difficult to get a good gross margin. What is really the money maker in a car is the intelligent driving. The fact that you can provide safety, you can provide, buy back your time with a chauffeur system, hands-free driving. Those are measured in many thousands of dollars and increase the gross margin of the car. So the car makers will compete on the level of intelligent driving that the car has, because from an engine point of view, the chassis point of view, the differentiation is becoming more and more problematic. Right? It is really the intelligent driving, the HMI, the driving experience. What are you providing the driver beyond the basics of an engine and a chassis? Right? This is where the big money is coming. So I think the opposite is happening. Car makers are investing even more in this area.
Yeah, it's been fascinating to have these conversations here on the ground about where the car experience is going. Professor Amnon Shashua, President and CEO of Mobileye, thanks so much for joining us.
Thank you very much.
And our thanks to our own Akiko Fujita for the interview with Mobileye CEO and President Amnon Shashua. Coming up, and right now actually, markets turn red after a green open as that December inflation print comes in hotter than expected. We've got our very own Jared Blickery over at The Touch with the latest moves. No Jared standing by. All right, so we're going to go to a quick break. Markets turn red after a green open as that December inflation print comes in hotter than expected. We have our very own Jared Blickery over at The Touch with the latest moves. Hey, Jared.
Hey there, Brad. Let's take a look at the price action for today. As you said, we flipped into the red from the green. However, on the announcement, what you're not seeing here in the pre-market, in the futures, we did initially take a leg down. So this is maybe a zigzag pattern, if you will. Let's check out what's happening in the sector action. Then we can get into some of the bond market movements as well. Here we have energy. That is the only sector in the green. Next to that, least bad off next to energy is tech. And then we also have healthcare. But down here, utilities. That is the interest rate sensitive sector. That's taking it on the nose. That's down over 2%, followed by financials. And we also have real estate and materials down materially as well. And let's take a look at the Nasdaq 100 because we saw a lot of outperformance by the mega caps yesterday, but that story is not continuing into today. We see Microsoft and Amazon up less than 1%, but Tesla, that's down 3%. It looks like Meta is down almost 1%, and so is Apple there. And before I move on, I want to get a quick check of the bond market as well. We saw the 10-year T-note yield. This is intraday. So first, we got a spike up on the inflation numbers, and then we retreated a bit, and we've kind of settled down to just about break even, just down very slightly 1 basis point. So not a lot of movement there. And just looking, kind of keeping with the bond market here. Here's the ICE BofA Move Index. This is like the fear index for the bond market. We can see this is right near multi-month lows right here. And the VIX itself, the VIX has been hugging multi-month lows as well. Here it is over the last 3 months. So not a whole lot going on in the bond market despite the inflation print. And by the way, I was looking at the history of market reactions to CPI. The prior two were to the upside in the market, but before that, we did get a downside movement. I would say overall that CPI movements tend to track the overall movement in the indices. We are at multi-year highs here in the S&P 500. In fact, we almost exactly matched the record high that we saw 2 years ago. So S&P 500 flirting with a really important level here. We'll have to see how it shakes out in the close. Here is our leaders index, leaders heat map, and we have solar energy, that's down almost 4%. Disruption as demonstrated in the ARC ETF, that's down almost 3%. Regional banks also doing fairly poorly here. Let's take a look inside ARC. We covered Tesla before, Coinbase, after the big ETF spot launch, we got that down 3.5%. And I'll just leave you with the energy market, a little bit of green here, guys.
All right, Jared, thanks so much for breaking down the moves that we're seeing play out following the inflation print that we got out this morning. Let's talk about one of the top trending tickers here at Yahoo Finance, and that is Hertz. We're looking at losses of just about 5% here, about an hour and a half into the trading day. The company selling about a third of its global EV fleet, and it's replacing some of it with gas-powered cars. Now, the car rental company blaming the reversal in strategy on weak demand for electric vehicles. Now, remember, this move coming after Hertz initially set a goal to electrify about a quarter of its fleet by the end of the year. So a massive reversal in the strategy that we're seeing from Hertz here. And Brad, what's also interesting to point out is some of the commitments or plans that Hertz had made surrounding Tesla and the vehicles there as they moved to electrify their fleet. Not too long ago, about 2 years ago, they announced plans for a massive purchase there of some Tesla cars. So obviously, this shift that we're seeing, the dramatic shift that we're seeing, points to the fact that we have seen waning demand for EVs across the board, because we can take into account some of those growth numbers that we've gotten out over the last couple of quarters, just 1.3% growth in EVs in Q4. So it really points to the fact that people are still favoring those gas-powered cars at this point.
And for any renters for Hertz cars out there, it also comes back down to the strength of the charger network, knowing that if you do rent one, you'll be able to make sure that you can get from point A to point B and for however long you are renting that vehicle. Just one other note on this, Hertz, as they report earnings, we're going to see them add a little bit more color to this around the overall process on February 6th. That's when they are putting out their fourth quarter 2023 earnings report. That is all from us today, everyone. For Brad Smith, Shauna Smith, the entire crew, we will see you tomorrow, Friday.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Inflation data coming in hotter than expected today. Consumer prices rising 0.3% in December, pushing the annual rate to 3.4%. Despite a rapid cooling through most of 2023, it seems victory cannot be declared against inflation just yet. And a milestone moment for Bitcoin after the SEC approved 11 spot Bitcoin ETFs. We'll speak with Wyoming Senator Cynthia Lummis this hour. Plus, my partner in crime, Akiko Fujita, has been bringing us key interviews all week long from CES in Las Vegas. We'll share her conversation with AMD later on in the show. But first, let's take a look at how the markets are faring an hour and a half into the trading day. We did see that selling action start picking up as we did get that information on December's consumer inflation data. So with that in mind, we're seeing the Dow here currently off about 200 points or about 0.5%. The S&P 500 also down about 0.6% or about 30 points there. We're seeing energy, the only sector there in the green. And looking at the tech-heavy Nasdaq as well, down 93 points or about 0.6% so far this morning. Well, let's see what that little bit of potential extra breathing room for the Fed did for the Treasury market. We're seeing the 5-year currently down about 0.8%, sitting at 3.95. The 10-year solidly above 4, though, but still ever so slightly in the red this morning. And the longest-term 30-year yield, that's up on the day, but ever so slightly, about 0.5%, sitting at 4.22. Well, the December CPI print showed prices rising more than expected to end 2023. So what does this report mean for the Fed as their first meeting of the year comes up in a few weeks? Joining me now is Yahoo Finance's Jennifer Schonberger with all that for you. Hey, Jennifer.
Good morning, Michelle. It's great to see you. That latest reading on CPI likely to dash Wall Street's hopes that the Federal Reserve could start cutting rates anytime soon. Excluding the volatile food and energy components of this morning's CPI, the Fed's preferred way of looking at this inflation measure clocked in at 3.9%, a hair above expectations of 3.8%. And while it shows continued moderation in prices, there's still much progress that needs to be seen as the number is still nearly double the Fed's 2% inflation target. And there was progress, though, I want to point out, in a key measure of the report that the Fed scrutinizes. That is the inflation measure of services less housing. That grew at 3.4% in December, down a hair from 3.5% in November. And if we look at shelter itself, that actually grew at a slower pace of 6.2% versus 6.5% in November. So while the Fed is encouraged by progress on inflation and all of its components, they really need to see inflation continue to move down on a sustained basis before they can turn to consider cutting rates. And that is exactly what we heard from New York Fed President John Williams yesterday. He said, quote, "I expect we will need to maintain a restrictive stance of policy for some time to fully achieve our goals, and it will only be appropriate to dial back the degree of policy restraint when we are confident that inflation is moving toward 2% on a sustained basis." Still, Wall Street hopeful, pricing in odds of better than 60% chance that the Fed will begin cutting rates in March. Of course, officials have priced in about 3 rate cuts this year, but no sense of timing on that. In fact, many officials pushing back on sooner. They're thinking more later at this point. Rochelle?
Certainly some water getting thrown on the momentum that markets had priced in there. Jennifer Schonberger, thank you so much. Well, as we noted, CPI came in even hotter than expected in December, and we can see the major averages reacting mixed on this news. Joining me now is John McClain, Brandywine Global Portfolio Manager. Good to see you, John. So give us some context here, because you're saying that this doesn't really move the needle in terms of the market narrative. Why is that?
Well, the market wants to go higher, and I think we got a slightly stronger CPI today, and we're seeing a bit of a pullback, but not anything meaningful right now. And, I think the 3 biggest things to take away from the CPI report, one being the shelter component up 0.5%, and that's in line with recent trend. But we think housing is going to be strong in 2024, and because it's the biggest component of CPI, that's going to be a real challenge to see us moving from kind of this mid 3s, high 3s type of number down to the Fed's target of 2%. And then other components that have been pretty volatile, things like airfare and used cars were only up 1.5%. So they're not as volatile anymore. So we're not going to see as much noise, I think. And then the last piece really is the medical care component, being up 0.6% for the second month. I think that's going to lead to the potential for some higher prints in 2024. So the market narrative has gotten ahead of itself. It's saying 6 cuts. It's saying balance sheet runoff is going to slow down here. We think that if that were to be correct, then the soft landing's off the table here. You're not going to see 6 cuts plus a slowdown of QT with the economy doing fine.
And so then as we look at some of the messaging here, I know markets looking for some clarity on the Fed kind of hedging their bets so that markets aren't really short, which is why they're running with sort of whatever narrative makes sense for them. But you compare the Fed and the market relationship to an old married couple. How does this relationship end up going from this point, given this data?
Well, again, the Fed's message is constantly muddled here. We had Logan saying balance sheet runoff's going to slow down. We had Williams contradict that. And the market just says, hey, risk on, and let's keep going and pushing stocks higher and bond yields lower. I think at a certain point in time, the data is going to support more of where the Fed is saying rates are going to be by the end of 2024, which is a couple of rate hikes, and it's not happening in March. And the market's gotten, again, way ahead of itself here. And I think we'll continue to get more data, and the market will coalesce to where the Fed is this time around.
And so then when you look at some of the fundamentals in the market, obviously we saw the narrow rally with the tech stocks, and then we saw that start to broaden out. But what are you looking at in terms of valuations at the moment?
Well, yeah, fundamentals are really strong, and we've got a number of conferences going on right now, the JP Morgan Healthcare Conference, the ICR Conference, CES, and kind of the information that we're getting out from companies here is that things are pretty reasonably strong in the marketplace. And we think we will see some nice top line growth and potential margin expansion from companies in 2024. The problem with this is that valuations are very high. You look at the S&P 500 trading at 22 times PE. That's an elevated level, particularly with Fed funds north of 5%. You look at investment grade credit spreads trading around 100. That's a pretty tight level. And same thing with high yield at about 350 spread. We're kind of priced for the soft landing, for the Goldilocks narrative, and it's going to be hard. And we think, as we mentioned a little bit earlier, there's going to be some conflicting data, which leads to the potential for CPI to stay elevated in 2024. I don't think we're going to be declaring victory before we have the presidential election.
So, John, then for those who are looking more long-term, what are some of the risks or the opportunities that you're looking ahead at, as opposed to sort of this jumping from month-to-month data as we tend to see markets do?
No, absolutely. I wish we could focus more on the longer term in these types of discussions. And really, there's 3 key themes that I think are going to permeate for the next several years. And one is deglobalization, one is decarbonization, and the other one is population demographics. As we're aging in the developed economy, all these things are inflationary in nature. And so I think inflation is going to be a discussion that we're going to continue to have for the foreseeable future, the next several years.
And of course, we're looking ahead to the elections in November. It feels like the election cycle just never ends, but particularly for markets, what sort of risk are they pricing in at the moment? Or is it really on the back burner as they're really hyper-focused on things like inflation and waiting to see sort of AI adoption and improvements there?
Yeah, absolutely. I mean, I think we'll start to turn our attention to the election next week with Iowa. But, I don't think that we're really going to be paying close attention until sometime in 2Q, and election risk isn't priced into the market. One way or another, the Fed's going to be politicized for how they act. We think that's wrong, but, the timing and size of cuts will impact who gets elected. We would also say that you want to buy risk into an election day, irrespective of the outcome. The market hates uncertainty, and as soon as that uncertainty is removed, despite the outcome, the market's going to move higher. We think that also going into this election year, you're going to see the Democrats looking to spend and stimulate however they can. Again, that higher spending and higher fiscal deficit is most likely going to be inflationary, and thus we believe that leads to that higher for longer outcome.
We'll certainly be tracking that. Great to get your take this morning. John McClain, Brandywine Global Portfolio Manager. Thank you so much. Well, December CPI report showed prices were higher than expected. We saw prices rise 3.4% year over year compared to 3.2% that was expected and 3.1% last month. Now, the energy index driving a lot of those gains. President Joe Biden and his administration as we head into the thick of a contentious election year. What does it mean for them? Well, we have Daniel Hornung, National Economic Council Deputy Director, joining us this morning. A pleasure to have you on the show here. So, I want to get your reaction to this CPI data because we really need to put it in context of how CPI has actually looked over the past year as well.
Well, it's good to be with you, Rochelle. You know, I think this morning's report was an encouraging one overall. It showed core inflation at its lowest level since May 2021. And we've seen that progress in the annual core inflation measure at a time when, over the course of last year, now that we have the full year of data, the unemployment rate remained below 4%. We saw 2.7 million jobs created over the course of the year, strong real wage growth over the course of the year. And that last point is particularly important because we now see wages adjusted for inflation higher than they were 4 years ago, which is really in contrast to the forecast that we saw last year that said it would take a big uptick in unemployment, a wage slowdown to get inflation down. That's not what we've seen at all. So we think overall an encouraging report. I think from the president's perspective, more work to do to continue to lower costs for American families, but an encouraging report signaling real progress at the end of 2023 heading into 2024.
And as you mentioned there, President Biden out with a statement, a White House statement saying there is much more work to do to lower costs for American families and American workers. But what are some of the ways that he can actually play a role in that versus what we already see naturally happening with the economy and inflation?
Well, we have seen real progress on certain key prices actually coming down over the last year as the economy has normalized, as President Biden's efforts to help fix supply chains and bring the private sector and labor together at our ports throughout the country has really worked its way through the system as more Americans have gotten back into the labor force, thanks in part to the strong labor market that really his policies have helped bring about. Looking ahead, you know, he's going to be laser focused on implementing historic legislation he's passed to lower prescription drug costs, to lower health insurance premiums, to lower clean energy costs. He's focused on taking on junk fees and doing everything we can to lower costs for the American people. And that really is in stark contrast to what we're seeing right now from congressional Republicans, which is a focus on, you know, having trouble even keeping the government open, focusing instead of on lowering costs for middle-class families on tax cuts for the wealthiest Americans and the largest corporations. So that's a real contrast in front of the American people right now on the economy.
And Daniel, when people are, you know, heading to the polls where they're deciding on a candidate, one of the things that really hits home for people is how they actually feel about their finances. And Axios and the Harris poll came out with a survey, and they said of the people who feel the worst about their finances and about the economy, Republicans, rural residents, renters, women, and singles disproportionately feeling worse there. So how do you connect the dots between some of the progress that you're laying out in the economy, but how people are actually feeling about that, considering that this is an election year?
Well, there's no doubt it's been a difficult several years for Americans coming out of the pandemic, coming out of the deep disruptions to global supply chains. I mean, we saw elevated inflation all over the world because of those issues. And so the president is really focused on doing everything he can to lower costs for families. The real wage growth I was talking about earlier is important because over a sustained period of time now, about 9 months, we have wages growing faster than prices. Our view has been that as that continues to sustain itself, that Americans will start to feel better about the economy. They've felt good about their financial situation themselves for some time, but I think those real wage gains, those increases in wealth relative to the pandemic, that'll help folks feel better about the overall economy as well. And we saw some initial indications of that in the consumer sentiment data we got in December.
And I do want to ask you about the consumer, because part of the poll that we saw here, John Gerzema, who's the CEO of the Harris poll, he suggested that people are consuming in denial, that they're continuing to spend, run up credit card bills as we see some of that credit card debt hitting $1 trillion, even though they're short on cash. But if people aren't feeling good about their finances, they're more likely to blame the government. So when you look at the strength of the consumer, but you contrast that with their debt and how they're spending, how confident are you about how the consumer feels about the president and how he's handling the finances of the country?
Well, we are seeing in the data strong consumer activity, as you mentioned, continued over the course of the last several quarters. That is really enabled because we're seeing a strong job market. We're seeing continued real wage gains. That means Americans have the resources they need to buy the things that they want and that they need. And the president is going to be focused on sustaining that strong economic activity, sustaining the strong job market, and really making the case to the American people that he has a plan that is about lowering costs for them, expanding opportunity for them, and that's in real contrast to the focus we see from Republicans on Capitol Hill. That's really about cutting taxes for the wealthiest Americans and the largest corporations, and that is their primary economic goal right now.
And so are there any headwinds that you see to that economic progress? A lot of people wondering if we're going to see a recession, if that's off the table. Is that something that you're forecasting?
Well, look, a year ago, I think that recession was very much in the base case forecast. We've seen tremendous resilience over 2023. We think as we head into 2024, we're positioned for continued resilience. Obviously, we need to continue to monitor all risks on the horizon. I think if you look across the global economy, the United States really is uniquely positioned for continued strong economic performance into 2024. But we'll be mindful of all risks on the horizon, from geopolitical risks to domestic risks.
I appreciate you taking the time to join us this morning. Daniel Hornung, National Economic Council Deputy Director. Thank you so much.
Great to be here.
All right, coming up, the approval of spot Bitcoin ETFs are creating a ton of buzz in the crypto world after the SEC greenlit 11 of them. Now, several ETFs started trading this morning. We'll hear from one of those money managers on the other side of this break. Several approved spot Bitcoin ETFs began trading this morning after the SEC greenlit 11 of them, including BlackRock, Invesco, and our next guest, WisdomTree, under the ticker BTCW. Now, the landmark approval paves the way for investors to gain exposure to Bitcoin as a way to diversify their portfolio. Let's bring in Christopher Gannati, WisdomTree Global Head of Research, to discuss this more. Thank you for joining me this morning. And of course, a long time coming, waiting for these spot Bitcoin ETFs. I want to first get your reaction, given that this was something that was 10 years in the making, now that it's finally here.
Absolutely. Thank you for having us today. At WisdomTree, we've been working towards this and managing globally cryptocurrency and Bitcoin assets going all the way back to 2019. So we've been very active within the space, been seeking to innovate. We watched a couple of years ago the futures-based strategy and recognized that there's just a difficulty in generating the exposure that way. So to be able to offer to clients the spot price exposure, which is what happened in these couple of days here, it's extremely exciting because it is a better structure, and really that's what we're focused on here at WisdomTree.
So Christopher, obviously you had a wave of them approved all at once. How does WisdomTree differentiate itself from the rest that have all launched at the same time?
That is the quintessential question. And so the fact that we have a large team, we're focused on this for years leading up to this moment, that is certainly a factor. It's going to lead to better research materials, ability to bring more value to certain clients and relationships. But you're absolutely right to note, at the end of the day, everyone is providing exposure. It's the same underlying spot-oriented Bitcoin ETFs. Many of the providers also waiving the fees to zero, at least initially, for various points of time and amounts. So it's going to be among the most competitive dynamics that we believe we have seen at WisdomTree in the ETF industry.
And this is something that you have already seen in Europe with your Bitcoin ETPs over there. Talk about how that compares to the market that you see in the US.
So it's fascinating to think about the fact that different regimes, different places around the world, regulatorily speaking, have had a different timeline to allow the use cases and ultimately exposures to spot digital assets. At the end of the day, when you look at the European study, a lot of those regulators and exchanges were earlier on the timeline, so a bit ahead of the game. It's fascinating to consider that in ETFs broadly, the US is ahead of and larger than Europe in basically every other asset class, with obviously the exception now of Bitcoin and cryptocurrency. So Europe has had basically a 4-year head start, but we're already seeing massive trading volumes today within this ecosystem that has been created with these 11 different strategies. So we'll see at the end of the day. I think in a couple of days with the futures-based strategy, there was more than $1 billion in AUM a couple of years back. And so at the end of the day, we'll have to see how these couple of trading days compare to that and where we are compared to European AUM within the first couple of weeks.
So I'll be curious to see some of the inflows. Obviously, you have a lot of institutional investors at the head of this, retail investors who, when you think of how Bitcoin started, and now you see some of these huge asset managers really taking the lead here to get this spot Bitcoin ETF through. What does that mean then in terms of Bitcoin's movements here going forward?
So we view positively at WisdomTree anything that gets more participants into the Bitcoin ecosystem as price positive, because essentially you think of the fact that there's a very, very defined, algorithmically driven supply of Bitcoin. And we have the halving event. The halving events, they happen every 4 years, roughly speaking. They're expected to happen in a couple of months here, where the block reward for the miners goes down by a half again. It'll be the 4th such event. And historically, that means there's less Bitcoin supply coming into the market. You have a potential source of demand here from a different range of investors. So you combine these elements together, and it's possible, like other commodities and currencies, if the supply is outpaced by the demand, you can have a very positive price dynamic. And that's what we ultimately expect. We just don't know the time frame, in the sense that was there some anticipation of this approval baked in? Do you see a little buy the rumor, sell the news for a couple of days here? We'll have to see how the short term essentially gets moderated into the medium and long term, which we think can be quite positive.
And I did think it was interesting that SEC Chief Gary Gensler was the one who gave that deciding vote to press ahead with these spot Bitcoin ETFs. But then as people are looking ahead as to what's next, what could be the next crypto asset to perhaps get this sort of treatment, what would you tell them? Because as you look at Ethereum and Ether, it's a very different ballgame when it comes to Bitcoin. Do you have any plans then going forward to perhaps include other crypto assets?
So at WisdomTree, we're certainly looking across the board. We have our WisdomTree Prime ecosystem, which is meant to really tokenize a whole suite of financial assets and allow direct spendability to the user, such that if people want to hold their money in different investable assets, be it treasuries, gold, Bitcoin, what have you, and directly go out and buy a coffee based on those underlyings, that's something we're bringing to the market. So we're extremely focused on the entire digital assets ecosystem and tokenized finance. And we are aiming to be first or close to first in any of those next developments as they occur.
Well, congratulations, of course, to this new development here. Thank you for taking the time to join us this morning. Christopher Gannati, WisdomTree Global Head of Research. Thank you so much.
Thank you.
You're very welcome. And for more on this monumental moment in crypto, be sure to stick around for our interview with Senator of Wyoming, Cynthia Lummis, at 11:45 a.m. Eastern. You won't want to miss it. All right, well, do stay with us. Coming up, we're in Las Vegas all week, bringing you the latest from CES. We'll bring you our conversation with the Corporate Vice President of AMD next.
Akiko Fujita on the ground here in Las Vegas at CES 2024, where the conversation has been about artificial intelligence, specifically about AI in devices. Talk more about that. We've got Jason Banta. He is the general manager for client OEM at AMD. So AMD first unveiled its AI PC last year. Certainly been a big focus here at CES this year. As you kind of assess the landscape, how are you thinking about this right now?
Yeah, so AI PC is a big topic of conversation. Thank you for joining us in the AMD booth to talk more about that. And AI PC is something that we're seeing emerge in the PC market overall. Really what that does is that brings AI capability that typically you see in the cloud or in server devices. You bring that locally into the PC to perform closer to the user. And that means a lot of things that you see from a generative AI capability in the market today, things like content creation or assistance, those things can actually happen local on the device, which brings a lot of cost and performance and privacy advantages to people accessing those generative AI experiences. As you mentioned, we introduced Ryzen AI, which was our entry into that AI PC market last year. We were the first to bring that into the x86 PC market, and we're making it bigger this year in 2024 with higher performance Ryzen AI engine, a larger portfolio on the notebook side, and we're also bringing it into the desktop market as well, bringing that Ryzen AI capability. So it's a big expansion for us from 23 to 24 from an AI PC perspective.
You mentioned a number of advantages when you get the AI on the device, but cost and performance specifically, what shifts as a result when it's not in the cloud and on the device?
Yeah, so the using generative AI or inferencing in the cloud, there are costs associated with that. Typically, that is the person who is using the device or using that experience is paying a cloud provider to access those generative AI capabilities. By having it local on the device, that model, that AI model, is really running closer to the user without accessing the cloud and requiring those cloud costs. The performance of it, you see lower latency because you don't have to send that data up, make a request, send it back. You can actually make that, whether you're generating an image or trying to get a response from a prompt, you can do that with lower latency by having it on the device. And all that information stays on the device privately as opposed to going up to the cloud. So there's a lot of advantage there from a cost perspective, latency performance perspective, as well as a privacy perspective. So all that really, the end user can see that when they get an AI PC in their hands.
We've certainly gotten to see, you could argue, a bit of a preview, right, in terms of the usage on the PC, Copilot being integrated through Microsoft, and enterprise certainly the first to kind of integrate in that way. But as you look beyond, how does this fundamentally change the PC experience for the user?
Yeah, the AI experience, I think, is probably the most transformational thing we've seen in the PC in a very, very long time. You talked about Microsoft. They were partnering with us in 23, and we're going bigger in that partnership in 24. They lit up some of the earliest experiences we've seen from an AI PC perspective, a lot of it around video conferencing. There are image enhancement things you can do in video conferencing that you couldn't do before, and you can do those at much lower power, much longer battery life by Microsoft building those experiences around AI PCs. You talked about Copilot, that ability to get that assistance and be able to use your device much more seamlessly, get what you want in natural language is something that Copilot brings. And so we're partnered with Microsoft on that as well. They're bringing Copilot to PCs. They talked about that late last year. And so we're partnered with Microsoft on a number of those. They're really our premier ISV partner when it comes to bringing AI PC experiences to the local device.
No surprise, we've seen some big announcements from your competitors out there as well. We were just speaking to Intel the other day. This really is, or seems to be, the big focus. How does AMD position itself in this space?
So we want to be first and best when it comes to AI PCs. That's our objective in all of our different IP, whether it's cores, graphics, or AI, is first and best in everything. From an AI perspective, you can really feel those performance benefits. So In 2023, we launched Ryzen AI with 10 tops of performance. We increased that to 16 tops of performance for our XDNA engine, which is the engine that powers those AI experiences. Enhance that performance, and you can really feel that when you get a response from a prompt, or whether you generate an image, some of the stuff that's going on behind us here, when you generate an image from a prompt locally on the device, it happens much faster because you don't want to sit, if you're trying to generate an image for a PowerPoint presentation or whatever, you don't want to wait too long for that response. So enhancing that AI performance brings that. And so we want to stay ahead from an AI performance perspective. And we want to do that in a much more accessible way. There's a lot of Ryzen PCs out there, so bringing that AI technology into the Ryzen devices is going to make it much more accessible to the broader market.
You mentioned desktop is sort of that next phase here. You've unveiled a desktop processor here at CES. It feels like there's more opportunity there, just given the power that exists, right, beyond the PC. I mean, how are you thinking about that piece right now within AMD?
Yeah, desktop is an exciting market, and that's why we made the move to bring out the 8000G products that have that Ryzen AI capability. A lot of our core market and a lot of our AMD audience is desktop based. They love the desktop device. And so bringing that capability in there, it's a lot of the same experiences that you would see on the notebook. So whether it's content generation or assistance, chat assistants, chatbots, et cetera, having those same capabilities on the desktop translate very well as they do on the notebook. So it's a big market that uses desktop PCs today, and so we wanted to bring those experiences to them as well.
As you sort of sit here and think about all the possibilities, and we're really just in the beginning phase, it feels like, about generative AI, how should we be thinking about where AI is headed?
I think it's very early, in the development of AI PC. I think the
AI experience in general, not just within PCs, not just within desktops, but I mean, you're right in the thick of it.
Right. AMD's uniquely positioned because we're, one of the few players that can really offer AI from the cloud down to the PC. I mean, there's not many players in the market that can do that. And to your point, we're very much in the thick of it. The adoption curve of this, or how exciting this is going to be, is really determined by those experiences and the development of those models. As we saw in 2023, the models got better and better. Fewer hallucinations, better accuracy to response to prompts. And so we're seeing that evolve with that model development, and as people research that and find new ways to generate models, we're seeing a lot of growth there. So they're looking at it saying, okay, this is more accurate. I can get more of the response I want from the model. And that's happening in real time. But also people are finding new ways. You look at some of the models that are out there, they're finding new ways to plug it into productivity tasks or other things. So the adoption of those models into content generation or getting responses or help with things, that's going to continue to evolve as it integrates into more applications that people are familiar with.
Yeah, certainly points to the big potential for AMD. Jason Benton, the General Manager for Client OEM, thank you so much for joining us.
Thank you, Kiko.
Thanks to our very own Akiko Fujita and Jason Banter there, AMD Corporation Vice President and General Manager for Client OEM. All right, coming up, what are CEOs most worried about right now, and what impact could their fears have on business? Dana Peterson from the Conference Board joins me next with the answer. Stay with us. Hotter than expected inflation data for December throwing cold water on markets that were eagerly expecting the Fed to cut rates as soon as March. CEOs in the Conference Board's newest report weren't so convinced about inflation being tamed and named it one of their top concerns, along with recession. Are they right to be worried? Well, to break down the report, Dana Peterson, the Conference Board chief economist, is here. Good to see you, Dana. So as we look at what we saw with Great to have you. So as we look at what happened in December with consumer prices coming in higher than expected here, put that into context and what CEOs are looking at that made them think that inflation wasn't tamed.
Sure. We did see lots of slowing in inflation last year, but then December we saw an uptick in the headline for the CPI. The good news is that the core is slowing, but it's still well above what the Fed is looking for in terms of 2% inflation, especially for the PCE deflator. So that really syncs up with concerns among CEOs about recession and also elevated inflation and higher costs of doing business. So I'm really not surprised that CEOs ranked those two items as being number one and number two for their concerns for the outlook for 2024.
So let's break some of this down because you have the external issues that they identified, economic downturn, recession, and inflation as well. But you also have some of the internal ones. I want to focus on those as well because some things are beyond some of these companies' control. But what are they seeing internally as well that's adding to the mix?
Sure. The biggest concerns among CEOs internally was attracting and retaining talent. That also doesn't surprise me. When we look at the US, you still have a number of industries that are suffering from labor shortages. And certainly we have the baby boomer population shrinking as they're retiring. And some of that retiring got pulled forward due to the pandemic. So many companies are having difficulty finding not only more workers, but qualified workers and keeping them at the same time.
And then another element they were looking at was accelerating the pace of digital transformation. Of course, we have to talk about AI. It's been all the buzz here. How are they viewing that? And what sort of investments, how are they prioritizing it right now?
Digital innovation has been on the top of the list for several years. And certainly AI has really come to the top of the list. And in fact, we did ask CEOs about AI, and they said, we're actually really excited about it. And most of them were either already implementing it into their business plans or thinking about it. And indeed, they think that it's going to be very productive and also increase the bottom line as well as raise profits and make their workers more productive.
And it's tough because we saw a lot of the enthusiasm in AI, but then you have a lot of workers wondering, well, what does that mean if more companies are going to be relying on AI for productivity? We've already seen some layoff announcements, mostly in companies, not just in companies that rely on AI, like Duolingo had their layoffs, but other companies continuing with layoffs as well. As you're looking at the labor market and the role that AI is playing in productivity, what are the expectations CEOs have there?
Well, for the most part, CEOs are kind of divided in terms of the impact on the labor market. Some of them think that is going to cause them to have to let people go. And then many of them think it's actually going to enhance the productivity of their workers. So there are definitely some risks and challenges around AI. Indeed, implementation, ethical use, regulation, all those pieces are coming together. And they do believe that they're going to need greater investments and greater integration among their workers to make sure that AI works for the company.
And as we sort of take a bigger view here and look at the global picture, we've already seen a global economic slowdown last year, and it looks like you're expecting global real GDP to slow even further to 2.5% in 2024. What's the base case there?
Yes, a big chunk of that is because Chinese growth is going to slow by about 1.1 percentage points from 5.2% last year to around 4.1% this year. And that's a function of an aging demographic, very weak consumer confidence that's leading to less spending, and ongoing crises regarding the housing market. Also, we think Europe is going to flirt in and out with recession. Certainly, Europe and Germany may descend back into recession. So we're seeing a very weak outlook for Europe and China. And in the US, we still do have a call for a short and shallow recession that's going to probably dissipate by the end of this year, but that still calls for weaker growth this year relative to last year.
And then, of course, keep an eye on geopolitics, not just with Ukraine and Russia. Obviously, Israel, you have the Red Sea issues there with the Houthi rebels as well. And, of course, the relationship between the U.S. and China. How do you see that playing out in terms of disruptions and how we might see that impact the global economy?
Sure, we're already seeing we've already seen the disruptions from the war in Ukraine, and certainly the metastasization of the conflict in the Middle East has resulted in shipments being stopped and attacked in the Red Sea. And that certainly is a big negative for trade between Europe, MENA, and Asia. So we could continue to see this. And there are also many other low probability but high impact events that could come to the fore, and many of them having to do with geopolitics, the relationship between the East and the West, the US and China, et cetera.
We'll continue to watch that, of course, as they're both of their economies, the two biggest in the world, and also in that sort of high-tech standoff here with AI right in the middle of it as well. Thank you for joining us, Dana Peterson, the Conference Board Chief Economist. Thank you so much.
Thank you.
All right, all your markets action up next. Stay tuned. You're watching Yahoo Finance. A joyous day for crypto investors. Several exchange-traded funds tied to the spot price of Bitcoin started trading in the US today after the SEC approved 11 of those ETFs. Now, the discussion around approving spot Bitcoin ETFs has been making headlines for a while, given the SEC Chairman Gary Gensler's cautious approach to cryptocurrencies and the risks associated, saying even as the regulator approved their ETFs that, quote, investors should remain cautious about the myriad risks associated with Bitcoin and products whose value is tied to crypto. But our next guest has always pushed for more crypto adoption. Joining us now is Senator Cynthia Lummis of Wyoming to discuss more. Good to see you again. So this is obviously a very historic day here and something that I know that you've been at the forefront of. I know you are a Bitcoin bull. What does this clear up now that we have this approval from the SEC?
Well, Rochelle, I'm happy to see this day come because it allows people who want exposure to Bitcoin, but are reluctant to self-custody to have that exposure as part of a diversified asset allocation. When the traditional financial services industry has now adopted and recognized the long-term benefits of Bitcoin specifically as part of a diversified asset allocation, it helps make the case for having a robust regulatory framework for digital assets so that investors can begin to further diversify their investments and incorporate a long-term store of value like Bitcoin into their investment strategies.
So, Senator, in terms of conversations that you're having on the Hill about how welcome this is for some of the lawmakers there, talk about those conversations and what this also means for your legislation, your Lummis-Gillibrand legislation as well, to really formulate this framework.
Senator Gillibrand and I, as you know, have the comprehensive piece of legislation that covers the digital asset industry and applies consumer protections to it. And so it can become a robust part of the U.S. economy. We are now behind many countries around the world in having a well-understood and secure regulatory framework. And because of that, the United States risks having the credible digital asset industry move to other countries so they can begin functioning in a well-understood regulatory framework. The fact that a Bitcoin ETF, in fact, I think 11 of them are now recognized, helps, I think, make the case for the fact that Lummis-Gillibrand is a piece of legislation that is ready for prime time, that it's important that this industry have a well-understood regulatory framework that lays on top of our traditional regulatory framework in order to enjoy the benefits of consumer protection and appropriate regulation. So it helps make the case for the importance of advancing the Lummis-Gillibrand Financial Innovation Act.
And just ever so quickly, we have about 30 seconds left. But obviously, this is good news for crypto enthusiasts. But for people who at this point still can't tell the difference between Bitcoin, an altcoin, or a stable coin, those consumer protections, do you feel as if there is enough protection at the moment to really offset some of the risks that dissenting vote that we saw from the SEC brought up?
I don't think that there is adequate regulatory protections to assure consumers that haven't taken a deep dive into digital assets. They need to be assured that the United States is not only aware but prepared to regulate in these areas. We need adequate staffing at both the Commodity Futures Trading Commission for Bitcoin and other commodity-like digital assets, and at the SEC. So it's very important that we advance legislation moving forward so people can begin to understand the differences between Bitcoin, other digital assets, stable coins, and involve themselves in this new economic opportunity.
Well, certainly at the forefront of everyone's minds, especially today. Appreciate you taking the time. Senator Cynthia Lummis, thank you so much.
Great to see you, Rochelle.
All right, well, that does it for now. I'm Rochelle Akufo. Stay with us on Yahoo Finance.